Evergrande has reportedly paid an onshore bond coupon due this week, but the embattled property developer still faces several more interest payments as fears over a possible default continue to mount. Our colleague Emily Tan filed this report.
It appears that Evergrande is prioritizing its funds towards the domestic market, where analysts say the stakes are higher for the country's financial market. The indebted developer has reportedly made an interest payment on onshore debt that was due yesterday, but that still leaves $5 bond interest payments that remain unaccounted for. The 30-day grace period for the first payment is coming up on Saturday, October the 23rd, so the market will be keeping an eye out as the deadline approaches. Evergrande has been trying to shore up liquidity, but with little success. Reports that negotiations to sell a 51% stake in its property services unit have been suspended after failing to receive support from the Guangdong government. Shares in the companies remain suspended pending an announcement of a major transaction. And this comes after Yuexiu Property backed out of a $1.7 billion deal to buy Evergrande's Hong Kong headquarters over worries about complications in completing the transaction. I'm Emily Tan in Hong Kong. Back to you.
This week's CNBC Sustainable Future Forum is taking place against a backdrop of spiking global oil, gas and coal prices. A key takeaway from our energy sessions is the pressing need to invest in making renewable energy cheaper. Steve spoke with the Siemens Energy CEO, Christian Bruch, and Snam CEO, Marco Alvira, as part of a panel on green hydrogen. Let's listen in.
The capital is there and it's waiting to be invested. What's lacking are the projects that are bankable. So the capital and the investors and the companies are ready to go. What you need to make a project bankable is to have the engineering defined, but to have the revenues defined as well. Now, the revenues of a hydrogen project still depend on some form of either incentive or obligation to have hydrogen. Because the gray is cheaper than the green, if you just say, let's do hydrogen, then there is already $100 billion per year hydrogen market out there. The exception is it's gray. So you need the fine print in the policies to incentivize or make it mandatory to switch from gray to green, to switch from gas to hydrogen, to switch from coal to hydrogen, and then it will happen very fast.
Christian, would you agree that the capital's there, that technology's up to scratch, we just need better regulation? I think all three of those points are probably debatable.
Well, as Marco said, I do agree the money is waiting there, but there's no commercial case for green hydrogen. I mean, this is one of the problems, what also Marco was alluding to by saying it's not bankable yet, which means we need to define boundary conditions which make this technology and these cases commercially viable. And we need an environment, obviously, of cheap electricity and, in this regard, abundant renewable energy available to do this. This is not there yet, and it means that certain boundary conditions in the market need to change in a long-term stable base that investors can go into these cases and say, I spent my money on it. If these cases are there, the money availability will not be the problem. And this will also then be needed to build up then the industry behind it, because also, I mean, at the end, you will need technical systems where you have the long-term reliability experiences. You know how to operate these systems for 10 or 15 years, because this is what you normally see in the power industry. This is all still to come to make it afterwards a commercial system. So the biggest problem is under the current boundary conditions, there's not yet a commercial case for green hydrogen. And this is why Marco, I believe, was alluding to the fine prints in the regulations. This is exactly what is needed now.
Well, today in the Sustainable Future Forum, our theme is industry response, and we'll discuss sustainable aviation with the Ryanair CEO, Michael O'Leary. We'll also cover green strategies with the CEOs of Zurich Insurance, Heineken, Aera and Nissan. And to round out the session, we'll be joined by Tanya Breyer and EcoAge co-founder and sustainability activist Livia Firth to discuss how the fashion industry can reduce its carbon footprint. And don't miss our colleagues on the APAC stage. Starting at 8 CET, they'll delve into water conservation with the CEO of Japanese drinks giant Suntory Holdings. So a good justification for you to have two screens there so you can continue to watch street signs and you can keep up to date on our sustainable future stories. Sri will also be joined by the Managing Director of India's Apollo Hospitals to discuss gender balance in the boardroom.
Coming up on the show, the UK government's pledge to build back better has fallen short of expectations, according to new research by Legal & General. The CEO, Nigel Wilson, joins us right after the break.
Welcome back, everybody. The S&P and the Nasdaq notching 5 straight positive sessions now, but Netflix dips in after-hours trade despite the business topping third-quarter earnings and saying that Squid Games is now its biggest TV show ever. Nestle hiking its full-year sales guidance with organic growth now expected to reach 6 to 7%. As the world's largest food group sees a strong return in retail sales and outside dining. Roche lifting its outlook for the year. It says it expects to hike dividends further as quarterly group sales jump 8%. And Gucci misses forecasts as third-quarter sales growth slows, hit by a resurgence in COVID cases in its key Asian markets, but Kering Group like-for-like sales jumping 12%. That tops expectations.
Massive session in 4 for the Dow, and health stocks are back in focus. Don't forget, through the United States, big dialogue around booster vaccines at this point, and Johnson & Johnson, fairly big mover in session yesterday for the Dow. But more broadly, investors have been concerned about the trajectory for inflation, what that could mean for central bank policy in terms of lifting interest rates down the track, which you would think would be a negative for technology names. But at this point, investors have managed to look through those concerns and been back on board with some of the big tech names. Apple yesterday, a big mover, and you could see 0.75% for the S&P 500, narrowing the gap towards its all-time high, only less than 1 percentage point off that record now. And you can see the Nasdaq very strong finish as well. Asian markets picking up on this lead. We saw a day earlier that big tech names that were supported stateside was a positive catalyst for a lot of these markets, and some of that continues again through the Hong Kong market, 1.1% higher. It is the strongest one. Slightly patchier elsewhere. The Japanese market was up 0.2 on a last check, only up about a tenth now, so very slim direction there. China is battling, again, more negative data, this time on house prices, stable for the month of September, not rising, which, don't forget, we've seen for many months over the last couple of years. We've seen that steady month-on-month growth, but the property market just battling the headwinds around the debt profile of Evergrande and some of the other property giants in the country. Australia bouncing 0.5%. At the opening calls, this is how we're setting up for the trade. Don't forget, yesterday we were mostly positive, modestly firmer on the German market, almost 0.33%, 0.2 up on the FTSE. And this morning we are looking patchy. In fact, it's the French market that's been a bit soggy this week. It was down yesterday, second negative session in a row, looking for a third at this point, Jeff.
Americans will be allowed to receive a different COVID-19 vaccine as a booster to the one that they were originally inoculated with. So apparently you can now mix and match vaccine boosters. The US FDA is set to greenlight this approach to provide flexibility to vaccine providers and states that have a build-up of stocks. UK Prime Minister Boris Johnson says the government has not been complacent as the country reports over 40,000 COVID cases for 7 days in a row and reports the highest number of pandemic-related deaths since March. Mr. Johnson said if current measures do not prevent, quote, unsustainable pressure on the NHS, new restrictions such as mask mandates and vaccine passports may well be introduced. Well, I caught up with Dame Kate Bingham, managing partner at SV Health Investors and the UK's former vaccine task force chief, on the sidelines of the Global Investment Summit here in the UK, where she told me the only way to prevent the creation of new variants is to get everyone jabbed.
Boosters will be important to retain protection for the elderly and the vulnerable, and there's unequivocal data that a third boost is helpful for that protection. So far, all the variants that are emerging so far are captured with all the current vaccines. So at the moment, we are seeing that the current vaccines are able to reduce death and hospitalisation and serious disease, which is incredibly happy, and we're lucky that that's still the case. Having said that, for as long as the virus is circulating unimpeded around the rest of the world, a solution for the UK will not be a durable solution. We have to get everybody vaccinated if we are to actually contain this virus.
Well, Kate Bingham also stressed that countries like the UK need to get more creative with how they invest in COVID-19 treatments.
At the moment, the vaccine formats are not really fit for purpose. They have cold chains, they're difficult to scale, they require, in most cases, 2 injections being delivered by a healthcare professional. So the first thing we need to have is a fundamental reformatting of vaccines, whether it's pills, patches, sprays, implants, whatever they are, which can be delivered by non-healthcare professionals, which can be scaled without that cold chain so that you can actually get to the whole world. It's no good, again, vaccinating the Western world without actually addressing all those people who are at risk. So I think vaccine format is an area of near-term investment opportunity. Manufacturing, obviously, we don't have enough or haven't had enough manufacturing supply, and there's lots of new technologies like blow-fill seal. So instead of using glass for vials for containing the vaccine itself, are there higher throughput, lower cost approaches, more eco approaches to actually vial the vaccines? Therapeutics, I mean, again, we have been quite slow to get targeted therapeutics. So I think investment opportunities into drug platforms that will allow very quick tailoring of therapeutics against new viruses is an area I would look hard at, whether that's antibodies or more likely small molecules. Antibodies are always going to be limited in terms of how many people can be dosed. And then more fundamentally, I still think immune therapies and modulating the immune response is fundamentally going to be the way medicine is moving.
British businesses have urged the UK government to come up with a credible economic plan as the country faces higher inflation prospects. Top executives have also called for a more flexible approach to immigration and skills training as sectors across the British economy face labour shortages and supply chain issues. A new report by Legal & General also suggests that the government's pledge to build back better has so far fallen short of expectations, with a deepening housing crisis and little adoption of green technologies. Nigel Wilson is the CEO of Legal & General and joins us once again on an issue that I know, Nigel, you're passionate about. Let me just ask you, I mean, did you troop up the hill to Windsor Castle yesterday and meet the Queen as part of Boris Johnson's desire to attract investment into the country? I mean, do you think events like yesterday's Global Investment Summit are worth holding?
Absolutely. Apart from anything else, I did sit beside Kate Bingham for quite a long time and had the privileged access, so I got the longer version of the great advice that she gave on this programme a moment ago. And yes, I was at Windsor Castle. I did meet the Queen, had a good conversation about her. I told her that I was meeting her son today to talk about sustainability amongst other issues. And clearly it was a very, very good session. I mean, the Prime Minister was on top form, and there was a huge amount of investors from across the world listening to the opportunities they have to invest in the UK. And as you know, I've been on the programme many times talking about what a great place the UK is to invest. We've had a lot of it to ourselves, I guess, for the last 10 years, but we will be joined by many others because there's a huge investment gap across the UK because we've underinvested in so many things for the last 30 or 40 years. So we need a massive step up in investment here in the UK because we want to be a higher productivity, higher growth, higher wage economy going forward. And we don't want, excessive house price inflation caused by shortages. And these are themes that we've talked about many times before on this programme.
Is there a bit of tokenism about the way the government's going about things? I mean, in your report, you talk about the need for a comprehensive economic plan, but what have we had recently? A gas boiler announcement programme, I think, within the last 24, 48 hours, which seemed to be very limited in its scope and quite expensive. We had an announcement on visas for foreign lorry drivers, which again, some have claimed was pretty much designed to fail before it got off the drawing board here. Is there a kind of knee-jerk element to these quick policy announcements designed to grab headlines but really not addressing the fundamental problem of Build Back Better and some of the current supply chain challenges?
No, I think you've made a very good point there. I think the Prime Minister is definitely pointing in the right direction. It's about delivery and execution, and as we've said before, we're actually brilliant at delivery and execution, but there's not enough delivery and execution going on, and we need, I think, bigger policy interventions and leaning in much more than we have in the past. And almost every issue we see, there's a bigger scale opportunity, and we're hoping the investment summit yesterday will be a step in the right direction. One of the points we were making in our report was you shouldn't have to be rich to be green. I think we've done, I think, the first real study on the inequality that arises in the greening of the economy and how difficult it is for poorer people to actually become green. And this, as you said, the boiler issue is a good example of that. The amount of money that's been put aside won't persuade most households in Britain to actually change technologies. And so we've got lots of great technological solutions around the world at the moment, but we're not implementing them fast enough or getting into the true economies of scale that we saw, particularly in solar, where we've seen a massive positive change in the pricing of solar over the last 20 years. And we've got to figure out how we go quicker. I mean, as Kate said, the vaccination program, we got the technology to work very, very quickly. we have to figure out how do we do these things more economic, quicker, and have a bigger impact. We've had 200 years of belching out CO2 in the UK. We've got 20 years to sort it out and really figure out how we can have a truly green economy and get on track to deliver our net zero emissions target by 2050.
Nigel, can I pick up on that point around the pace of change, because the Prime Minister has made it a point to try and race towards net zero. But I wonder whether it's a case of slow and steady wins the race, because at this point, as you mentioned, the boiler issue and other initiatives, we're talking about a very expensive bill here that no doubt will be footed by the taxpayer. We're talking about higher taxes potentially, possibly even inflation, which, as we all know, can derail an economy. And one would expect a stronger economy would be one that can pay for changes. So do you have concerns about the pace that the Prime Minister is trying to execute on some of these changes?
Well, I think the execution is difficult. As we were saying, that there isn't enough policy intervention so that we can go fast, but it's a step in the right direction. You're right that actually a good economic background with ever-increasing wages and much lower house price inflation would be a good background to introduce some of the ideas that we're thinking about right now. But we haven't got there yet. As you rightly point out, there's still lots of demand and supply shocks going on in the world, and we're all working our way through these quite tricky times with huge spikes in demand, huge spikes, issues in the supply chain, and massive price impacts that we don't fully understand what's going on in the economy.
Can I get to some other practicalities here as we talk about retrofitting and what is a very old stock of housing across the country? It comes at a time when pricing has been a little bit more uncertain than it has been for decades. We had Brexit that's impacted pricing, and of course a pandemic. It's all very well to invest in housing and to try and upgrade when you've got a house price market moving aggressively higher, because it can be justified because you've got that capital appreciation. Is it going to be more challenging at this point for many people across the country to upgrade those homes to embrace new technology given the pricing environment?
No, I think that's a very insightful comment. I think retrofitting houses in the UK is one of the really, really difficult challenges we have. 22, 23 million houses need retrofitting at anywhere between £20,000 to £40,000 per house. That's a huge amount of money for most people. And how we do that, there isn't really a plan for doing that right now. And I'm not sure whether slow and steady is the right way to go about it, but we're not even going slow at the moment. So there's a huge amount to do in that area. And I'd love to say we have a solution to that. We've done a really good job of solving many of the economic issues around the UK. Retrofitting houses is one that we have also not come up with a good solution right now. And that could be a huge growth industry if we can get it right. But at the moment, it's just a big problem in the UK with nobody coming forward with really, really practical solutions that can be delivered at scale.
We better ask you a question about business. I know there's probably a limit to how much you can tell us at the moment, Nigel, given that we're in Q3 earnings season. But how's life domestically and internationally at the moment in this segment?
Yeah, I think terrific. I think we're not great believers in quarterly earnings, so we don't have to worry about Q3. But I think we have seen ours as a really resilient business throughout the pandemic. We had a pretty good year last year, and we've had a very good year this year. And there's many trends that have accelerated during the pandemic, which we're capturing. So we're seeing very strong demand for most of our products and services across the world. In America, certainly in the UK, we've done better in Europe than we expected to do this year. And we're making good progress in Asia. But going back to the point you were making earlier, there's lots of things that we could be doing and doing more of and doing better that we're not really getting to grips with at a macroeconomic level in the UK. And certainly these are big opportunities for us going forward, but we haven't really got solutions for them right now.
Kate Bingham was bending your ear about why the insurance companies aren't investing more in the startup healthcare sector, because that was something that she spent a lot of time telling me yesterday, that when are these big insurance companies going to get off their butts and find a way of putting money into the startup healthcare sector? But Nigel, is it because you don't want to, or is it because the rules around pensions and management of pensions don't let you?
three very good points there. One is Kate is very much driven about that, and we have had a lot. We're working with Kate to see how that can be done, and Sir John Bell, how that can be done. And we do invest in the sector already, and it's been very successful investment. You know, we've got some brilliant science in Britain. So the contextual background is one that we want to get in. We've done some, but not at scale. The reason we don't do it at scale, as you rightly point out, is the pensions rules aren't flexible enough in the UK. That's something the Chancellor can sort out. If he truly wants to see the UK develop these new industries at scale, and that people like Kate get the opportunity to really get the absolute best potential out of the UK and get financed by us and others, they've got to free up the pension industry in the UK to invest at scale. He can do that if he wants. We look forward to him doing that at the budget.
Nigel, thanks for joining us today. We look forward to talking to you soon around earnings. Nigel Wilson with us, CEO Legal & General. We know something that the fashion crowd doesn't know, Jeff.
Do we? Not how to be fashionable.
No, the Gucci effect, has it faded?
Wow.
We see the numbers first. Kering sales, the group has been reporting, and the numbers are disappointing, particularly around the Gucci division. We'll bring you the latest next. Main fashion house Gucci grew sales by just under 4% in the third quarter, missing analyst expectations as the recovery slowed in Asia. Overall sales at the French luxury group were up over 12%, driven by strong performances in the United States and Western Europe. Let's get out to Charlotte for more. Charlotte, I was teasing this up. I mean, Gucci was a business for Kering that was growing at 40+% at its height, now less than 4%. Quite a huge amount of slippage. Is that telling us this Gucci effect that really upended the fashion market has now faded?
Well, has Gucci come out of fashion? That's really the question. What investors have been keeping their eyes on. And look, Kering has been warning that over normalization at Gucci for years. They had an extraordinary ride since 2015, the revamping of that brand. As you say, some quarters were incredible growth. And now they mentioned that in this quarter, they had some of the restrictions, COVID restrictions in place in Australasia that has impacted sales there. But there, the results at Gucci were definitely was expected. Bearing in mind that Gucci makes almost half of the sales, almost 3/4 of operating profit for Kering. So of course it's extremely important for the group, and there the results were way below expectations, as you say, with sales just up 3.8% on comparable basis. But look, they've tried to assure the market, say, look, Q4 will be better. They have several events that they think will boost sales heavily. They have a new collection called Aria that's just launched in October. They saw a very good beginning for this collection. It's very, very awaited. They have a Gucci and Balenciaga collaboration, another Kering house that's coming out that I think will boost sales. Also, there's a new movie coming out, Ridley Scott movie with an all-star cast called The House of Gucci, which I think will give some extra exposure to the brand, and expect what the CFO called yesterday a very intense end of the year. Now they say they're making some extra investment as well in the brand, in marketing and innovation, etc. They say we'll hit margin growth in the second half. They say we'll bear fruit afterward. And also a positive note is that they've been working on refreshing some of their other brands at Kering to kind of reduce this over-reliance on that Gucci brand. And there the results were much better than expected. Yves Saint Laurent, the second largest house, their sales were up 28%, and Bottega Veneta up 9%. That was all above expectations. So maybe you see that Kering, actually the work they've been doing for the past quarters and few years of trying to balance between the different brands is bearing fruit. But these results at Gucci will be concerning investors, whether we see a rebound in Q4. Also, we saw this common prosperity policy in China that's been affecting luxury stocks heavily in the past few quarters, and the slower economic growth in China, as well as we saw in the GDP numbers earlier in the week. And we know that Gucci is very reliant on these Chinese consumers as well. So there'll be some question mark, and we'll see how investors take these results this morning. Karen.
Charlotte, thank you very much. We're just pondering pricing off camera. I think luxury is too expensive now, and as we know with a lot of retail businesses, it's pricing and volume. We saw at the other end through Nestlé that they had a mix of both, and I think luxury for a long time has had a pricing power. You've seen very aggressive increases, and it's also had volume thanks to the Asian market. I wonder whether some of these features are coming unstuck now. Don't have volume, don't have pricing power, and you maybe you're just seeing it through the Gucci lens. Saint Laurent, which is one of the other brands that has done particularly well, often noted for being hugely expensive, has actually introduced some more affordable items, which tells you about that pricing product mix in a business.
It's interesting, isn't it? Because I think in economic terms about luxury, and it's a way of distorting the supply and demand curve, because you end up with an item, I guess, like tobacco, which has a different shape curve, which suggests that actually the consumer is largely price insensitive because they are just willing to pay whatever is demanded for the item. What you're suggesting is now that actually we're getting to a point in that curve where even the consumers that are best well-heeled are unwilling at this stage to pay those higher prices. But as we know, you do a lot of damage to a brand if you go too far in the opposite direction. And we've seen that with a lot of other companies over the years. Sometimes, I mean, this idea of affordable luxury, I think, is almost a misnomer.
Yeah, I mean, a lot of the brands used to have items where it would keep younger audiences and those that wanted to scale up eventually to be able to afford the products sort of on the hook, that they could still afford to buy some of the products. I think a lot of that's changed. We've seen huge escalation, not just in the leather goods, but also in the fashion items as well. And I think that's a problem when we talk about inflation elsewhere too.
Yeah, well, we're going to talk some more about inflation in just a moment. When we come back, energy prices and supply shortages have piled inflationary pressure on the UK economy and other economies around the world. We're going to talk about that when we come back. We'll get UK CPI numbers shortly. very warm welcome back to the second hour of Squawk Box. The S&P and the Nasdaq notch 5 straight positive sessions, but Netflix dips in after-hours trade despite the business topping third quarter earnings and saying Squid Game is now its biggest TV show ever.
Nestle hikes its full-year sales guidance with organic growth now expected to reach 6 to 7% as the world's largest food group sees a strong return in retail sales and outside dining. Roche also lifts its outlook for the year and says it expects to hike dividends further as quarterly group sales jump 8%. And Gucci misses forecasts as third quarter sales growth slows, hit by a resurgence in COVID cases in its key Asia market. But Kering Group's like-for-like sales jumped 12%, topping expectations.
So welcome back, everybody. Of course, we're very sensitive to the UK inflation data here, given the comments that we heard from Andrew Bailey, the Governor of the Bank of England, suggesting that we may need to look at sooner rather than later interest rate hikes here in the UK. So what do the inflation numbers tell us? Well, the headline CPI has come in at 3.1% year on year. The poll expectation was for 3.2%. So this pretty much in line, modestly off the run rate of expectations. The September CPI in at 0.3% month on month. The Reuters poll was plus 0.4%. So far, so encouraging for those who are hoping that actually the bank won't pull the trigger too soon. The core CPI ex energy, food, alcohol and tobacco, basically the sustenance of life, it would seem, has come in at 2.9%. The Reuters poll was for 3%, so that is below the expected run rate. The September core CPI ex energy, food, alcohol and tobacco, 0.4% month on month. The poll expectation was for plus 0.5%. The ONS says, this is the Office for National Statistics that compiles the figures, says the largest upward contribution to the September CPI was 12-month inflation, or the 12-month inflation rate coming in from transport at 0.91 percentage points. Restaurants and hotels made the largest downward contribution to the change in those figures. We're also getting some interesting input and output prices, which it's worth just dwelling on here as we look at where some of these pricing pressures are showing up. So the September producer output price is plus 6.7% year on year. The poll was for plus 6.8%. That is lower than. Producer input prices 11.4% year on year. The poll 11.6%. Producer output prices plus 5.9% year on year. Producer output prices for the month on month comparison plus 0.5%. That is in line. Where we do see, well, to be honest, though, no, they're all a little bit lower than the poll expectation. The September producer input price month on month plus 0.4%. The Reuters poll was for plus 1%. I suspect that there will be a sigh of relief over at Threadneedle Street as they look at these data points, which they will already have seen, and they ask themselves, have we actually seen the peak in, wait for it, transitory inflation trends? Now, one swallow doesn't make a summer, and obviously we've got to wait and watch to see what happens next in the series here. But the fact that these numbers weren't significantly above the poll expectations will be seen as a positive. And I think we just need to continue to watch the sterling market, and in particular the gilt market, which it seemed to me moved very quickly to reprice expectations that the Bank of England would move maybe in November, but at least before the end of the year.
It's extraordinary, isn't it, as we talk about central bank policy here. We're all alert for a live meeting at some point this year. But, you know, 5.9% year-over-year increase in those core producer output prices, does it truly encapsulate what's happening across the economy? Because if you look at reports from certain sectors and industries, they are suggesting that you've got a much steeper increase in prices. I mean, manufacturers, heavy industries, some believe you've had a 30 to 40% increase in material prices, energy, shipping costs all going up, and that means that you've got much more of a weight on pressure on these producers than what we're seeing in the official stats. That's one of the questions I have, is whether the current series truly does reflect what we're seeing out there in reality, and also, you know, what the average consumer is going to face. We've X'd out everything as we talk about stable prices, as you say, energy, food, tobacco, but a lot of people do go to supermarkets, they do go to cafes and restaurants, they do spend money on these items, which means they do have real inflation as they look at what they have left in the bank.
This is setting us up deliciously for Rishi Sunak's autumn statement, which we will get. This is an autumn budget statement which we will get on the 27th of October, and at the moment he is under a lot of pressure to give more money away at this stage, and a lot of people that are saying that the economy is not healed, that there is a lot of scarring, and particularly at the level of those who are the lowest paid or not working, who need additional help at this stage because we are not through the pandemic yet. There's a lot of pressure for him to keep up the support at this stage. But we know Rishi Sunak's nature as a Tory Chancellor is to try and begin to deal with this deficit meteorite, as it's been described, that has been the result of the huge spending that we've seen to try and address the COVID crisis. So hard at this point to, especially when they look at these numbers, to think that inflation may necessarily come to the rescue and start to eat away at some of that huge debt that we see in the UK and the deficits that the government has been running to meet these payments around the furlough scheme and food stamp programs and so forth.
It's a complex issue, I think, as you talk about navigating from here. I mean, what happens if you put up interest rates, which we know is a blunt instrument? You've had people who've built up savings who've been able to, so what, they get a higher return on those savings. Others who've paid down debt, will they really be hurt that much by a rise in interest rates from very low levels? And of course others may have taken on more debt because they thought it was safe to do so. So perhaps there's the other side of the coin where any increase does have an impact. The other point here is that I think we've been looking at finally some normality in supply chains around the corner, but with very high demand still, that should sustain economic recovery and pay for all of the challenges that we have ahead. If you start tightening the screws on consumers, and that's with rate hikes and with interest rate hikes and higher energy prices, what does that economic growth story look like for the next couple of years?
And that's the balance, isn't it? Because we know that Rishi Sunak earlier in the month told the Tory audience that his preference was for tax cuts, but the government borrowed a record £299 billion between April of 2020 and April of 2021. And who are those interest rate hikes going to hurt? They're going to hurt us all if it increases the government's debt servicing costs, because that is money that is effectively going down a black hole. It is not going to invest in businesses to do the kind of things that Nigel Wilson is hoping that the British government is going to do, which is to try and invest in businesses and build back better that will create an economic return. If you are just servicing your debt, we know that that ultimately is not helping grow the economy.
Yeah, and then retrofitting your house as well as the normal maintenance we seem to have to pay for here. Let's push on to German PPI. That is a hot number, 14.2% year over year. This is higher than the forecast number of 12.7%. The September PPI on a month-on-month rate is plus 2.3% for the month. This is not going to be welcome news for a lot of Germans. The forecast was 1%, so exceeding on the year and the month over rate. So you can imagine the hawks will be active later on today. Asml's third quarter core earnings have missed analyst estimates. The Dutch paints maker was hurt by high raw material costs and supply chain disruptions. Adjusted operating income fell 32% on year to 241 million euros. Terry Van Lacker joins us now, the CEO of Asml. Terry, nice to have you back on board with us. Can I just dig into this raw material escalation that you're seeing, that the price rise that is impacting the business? How bad is it, and where in particular are you seeing those increases coming from?
Yeah, good morning. And first of all, it's indeed a bit of a peculiar situation because we're actually pretty happy with how we are catching up with our own pricing, with what's happening with raw materials. To be honest, to answer the question on where do we see it happening in our raw materials, it's happening across the board. It's both pricing and availability. Pricing levels are up quite significantly. As we said, for the average of the year, it will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers. Availability is somewhat normalizing, where it was the big products in the beginning of the year. It's now basically a slew of smaller additives and packaging that is hampering us. We do have about 100 million euros of backlog in orders at hand for our products that we cannot supply. Now, the additives is in volume maybe a smaller part of our raw material basket, but nevertheless, if we put 1% of a specific product in many formulas, we cannot ship those formulas. We do see it stabilizing, albeit at a sad high level. So for us, for the company, it's really showing the resilience to catch up by the end of this year, to have our pricing in sync with what the raw materials are doing.
Can I just dig into that then? When you've got pricing initiatives, and I've got a line here, Q3 pricing up 9%, how willing are you to pass on all of the cost to consumers at this point? And is there a tipping point where they'll push back and won't be willing to purchase the product? Do you see that sensitivity at some point down the line?
Yeah, well, it's not a willingness to pass on, it's a necessity to push on, and it's really a real clear mandate that we will push that on. At the end of the quarter, so the run rate of our own pricing was 10%, so we were up quite significantly, and we need to do an extra step in the fourth quarter still. By the way, lots of work and very good work from our teams to get it happening. It also shows the traction that brands like Dulux and Sikkens and Allgrip have in our markets, because that's basically what customers want. I just want to point out, though, that although, of course, there's not one of our customers who likes this, the reasons are pretty obvious for everybody. One would expect that any other paint and coating supplier that has a semi-rational view on things has to do the same thing. And in fact, don't forget that this is also in a very constrained availability environment. So as such, we don't think we necessarily get to a point where there's going to be repercussions or demand destruction at all. We do hope for everybody, however, that this starts stabilizing soon, because it does make in the channel a lot of things, or the chain, it makes a lot of things very uncertain for some of our customers who have to quote to their customers on how are these things going to evolve. But I think so far, I think we've been doing it in high speed. I think we were reacting faster than many others in our industry. But I think it's well understood and it's well managed by our marketing and sales organization on how to explain what is going on there.
Thierry, away from the price increases, just on that question of sales, how would you characterize where we are in the business cycle for you? Do you think that we are close to the end of some of the supply chain disruptions that have obviously impacted the end users of your products? Do you think that we're at a turning point potentially here for an uptick in sales activity?
Well, actually, our sales activity is extremely encouraging. So across all our segments, the demand is actually very good. So that is not an issue. And that also probably explains why we are pretty successful on our pricing work that we have to do. What we do see, and maybe that's answering the question, what we do see is a stabilizing of the situation. So when we look at our raw material basket, month over month, we had significant increases on how it was going to hit us. It's kind of stabilizing right now. It's plateauing at a high level. The amount of force majeures is so the suppliers that really have an issue cannot supply. Also, that has been plateauing. So that is typically the precursor for getting back to normal. If you take really 3 steps back for our industry, the demand is pretty strong, but it's not exceptional, so there is no real dislocation there. If you compare it with 2019, if you look at the overall supply of the vast amount of raw materials that we buy, that's not structurally changed either. It is really the whiplash coming out of COVID with some weather effects and then some logistical constraints on shipping that really makes markets out of balance. And we do expect that, yes, in the first half of 2022, we will probably still see quite some of the impacts of that. But that is, we believe that that would then be the precursor of getting back to normal. So I think for 2022, we do see a mirror effect where it starts normalizing in the second half of the year significantly.
Just a couple of sectors, if I could ask you to focus on those specifically, just because of where we are on both of those sectors. One is your automotive coatings business, because we keep hearing companies telling us that they are suspending production or they are delaying production because of chip supply constraints or other parts problems. And the other is in housing, because we had a drop in US housing starts reported yesterday. Building permits were down 7.7%. I just wonder if we're seeing in both of those sectors continued distress or continued problems around coming out of the pandemic-like conditions.
Yeah, well, the two examples you give is where we are actually not that active. So we're not in decorative architectural paints in the US. The European, Asian, Latin American markets for decorative coatings are actually much more renovation markets, and that is actually going very well. You may remember there was in 2020 the COVID boom, I would say, for do-it-yourself. That has started to normalize as we had predicted, but it is normalizing consistently at mid-single digits above where it was in 2019. But in 2020, the professional market, the painter that comes to your house to do the outside work, the woodwork, etc., that was actually down in 2020, and that has actually come back at 2019 levels. So overall, our decorative paint business is doing very well. Add in some very, very nice share gains in Latin America, and the fact that our Asia team in China has been proactively sheltering the business on retail and not the big national developers. So everything that's going on the real estate development, we're pretty much sheltered from that. Our decorative paint business is doing quite well. So in that sense, I think it's pretty positive. On automotive, we're one of the three big paints and coatings companies in the world, but we're somewhat less exposed to the car OEM market. We're more in the refinish, the aftermarket, and then in shipping and all other areas in there. The products that we do supply into the automotive market have more to do with the powder coatings that go on exterior parts. There we see it actually pretty well hanging in there, because it also goes in sometimes different markets. But we are overexposed, I would say, to the electrical vehicles, the batteries, both around the battery and in the battery, and that is actually doing quite well. So if you look at our automotive numbers, you wouldn't necessarily see much of the chip shortage as some people talk about it, but that's more because of the peculiarities of our business.
Thierry, I was going to ask you about China, but you've really answered it there on the property issues with Evergrande. So let me ask you about the retrofitting question and ESG, because it feels as though governments globally are now pushing towards greener homes. And we know as soon as you conduct any maintenance or change, often you need paint as well to try and touch up what you've damaged in the process. Is there potential down the line around ESG that you may see some upside?
Oh, absolutely. Absolutely. So if you look at the markets where we operate in and what needs to be done to either comply with a mandated EU Green Deal or just the energy costs that are spiking up in many parts of the world. I mean, yes, there would be lots of renovation or adjustments in the house, and you're right. At the end of any activity, there's typically a Dulux moment at the end. So we're actually pretty positive around the developments for our decorative market, together with our market shares and the fact that we've been gaining market share around the world, puts us in a very nice position in 22 and 23.
Thierry, we're going to say goodbye, but thanks so much for joining us and for the fulsome answers. Thierry Van Lacker, the CEO of Asml. Nestlé has lifted its full-year outlook, now expecting up to 7% organic growth. This after the food and drink conglomerate put in strong third quarter organic sales, which beat expectations, rising 7.6%. Nestlé expects its underlying trading profit margin to come in at over 17%, despite continued pressure from rising raw materials costs. The company cautioned last month that inflation pressures could be higher next year. Strong demand for COVID-19 tests driving Roche sales up 8% over the previous 9 months. The Swiss drug maker lifting its full-year outlook, having previously predicted a slowdown in demand for its tests in the second half of the year. Sales in its diagnostics division up nearly 40% then in the first 3 quarters of the year. The company says it now expects continued growth in the division as well as a possible boost from an Alzheimer's drug under trial in the United States.
Let's take you to European futures as we count down to the session. Early signals have been weaker, particularly for the French market, 4/10 down. And at this stage, before the open, looks like it'll outpace to the downside the German and UK markets. Coming up, I don't know about you, if you're ever stuck in traffic around a staycation, this might be appealing. Flying cars by 2024. That's one Chinese automaker's promise to the market, to consumers. We're going to bring you the latest on that after the break. A big day for luxury today. Burberry now out with its new CEO. We've been waiting for an announcement after the recent news that Marco Gabbetti would be leaving to go to Salvatore Ferragamo. And just crossing the wires a short time ago, the news that Jonathan Akeroyd will become the new CEO of the business. Akeroyd has been over at other fashion homes too, Versace and Alexander McQueen. So no doubt bringing a little bit of sizzle to Burberry. These are slightly racier houses as you think about the product that they've served up to customers, from Versace to McQueen. Burberry a little bit more conservative typically than where he's been, but this will be effective as of the 1st of April 2022, so a little bit of a gap in terms of when he does come on board, and that'll be something that investors obviously will have to weather, but we still have of course that departure from Gabbetti here. But I think that's interesting news, and luxury's certainly been fascinating this morning. Which way will he steer the business, further along the fashion catwalks or towards an acquisition or takeover?
All of the above, possibly on the list this morning. You mentioned the word steer. That leads us neatly into this next story. The Chinese electric car maker XPeng. Of course, we've talked about this business a little bit in the past, and because of Karen's traumatic trip to Norfolk, where she was stuck in traffic on a staycation, I think we do need to discuss the options for flying cars going forward.
Absolutely.
It's not just in the Jetsons, you know, they are now going to be building one of these things. Let's get out to Arjun, who's going to tell us a little bit more about where XPeng is going. Arjun, we've seen you on this flying car story for a while. When is it actually going to take off commercially?
Yeah, you're seeing testing being done quite a lot. You know, Jeff, there's a lot of challenges that still remain. Regulation very much key to that, as well as being able to safely operate this. And there are still question marks over the business model and commercialization path for these flying vehicles. But just in relation to XPeng, they're very much a new challenger into this space at this point. They have an affiliate company called HT Aero, of which XPeng's founder and the company itself are investors. They've just raised $500 million from a number of high-profile VCs here in China, as well as XPeng investing as well. Now, the money's going to be used towards R&D, and in particular, the company says that it's now looking into a vehicle that can drive on the roads and operate in the air as well, which could help with Karen's traffic problem. At this point, they say that also they're planning to roll these vehicles out in 2024, so pretty ambitious. And just a note on XPeng as a company, why is this electric vehicle company now trying to push into flying cars as well? I caught up with the CEO pretty recently, and we spoke a bit about the strategy. He was saying, well, the way we see it is mobility is going to come in a number of forms, whether that be electric vehicles, whether that be flying cars, and also they've released some robotics prototypes which they feel could be useful in certain situations as well. So that's really the thinking behind it. But as I mentioned, lots of challenges still remain. There are a number of companies around the world looking at this technology. Regulation will be key, safety, and of course, can they successfully commercialize this and have a viable business model going forward? Guys, back to you.
Arjun, just before we let you go here, we've had 7 days of gains in Tesla's share price. We're obviously very focused on what will be delivered in the third quarter earnings, and we know that the company has had some issues in China in recent months, but it's such an important market for them. What are we looking for?
Yeah, well, we saw Q3 deliveries coming very, very strong, ahead of expectations, and therefore the market's expecting a pretty solid earnings report as well. We've seen some recovery in the China story as well after those issues earlier this year with some of that bad press. And just anecdotally, I mean, walking around the streets of various cities in the past few weeks, you see a lot of Tesla cars on the road. They have a very strong brand premium here, even as the competition continues to rise from the likes of NIO and XPeng and others. Tesla still holds that high premium brand here. Of course, I think a lot of people are going to be watching for a couple of points. Firstly, when Tesla sees some of these chip and supply chain issues easing as well, and also looking at questions over when production will begin at 2 key factories, the new one in Berlin and the new one in Texas as well. That's going to be pretty key, and obviously any positive messaging around that, as well as a continued recovery in the China market, will be very positive for the Tesla story going forward.
Arjun, thank you very much for that. I've been pondering the whole time how long it would have taken me to get to Norfolk if I had that bus instead of 5.5 hours from London that time. How much quicker would it have been?
But what are you going there for anyway? The turkeys, the mustard, the Broads? I mean, there are some attractions in Norfolk, but I don't know, I wouldn't sit in 5 hours of traffic for... All right, let's not get into this. I'm getting that look. So
there is a pub we like there. There's one pub we like. It's a lovely, lovely pub. It has an outdoor area, playground, great pizzas.
Yes.
We drive for about 5.5 hours to go to that pub.
Definitely sounds worth it to me then.
We are counting you down to the start of the European trading session. Signals are weak, as you can see, 2/10 down for some of the markets. A little bit more off the French mark early. Stay tuned. We'll get you set up for the trade. Welcome to Squawk Box. If you are just joining us, here are your headlines today. UK CPI comes in slightly weaker than expected on the month and the year, but still gains over 3% annually, while German producer prices surge more than 14%. Nestle hikes its full-year sales guidance, with organic growth now expected to reach 6 to 7%, as the world's largest food group sees a strong return in retail sales and outside dining. Roche also lifts its outlook for the year and says it expects to hike dividends further as quarterly group sales jump 8%. And rising raw material costs take the gloss off Asml's third quarter earnings. The CEO, Thierry Vanlancker, tells this program pricing pressures will only increase going into the new year.
Pricing levels are up quite significantly, as we said, for the average of the year. It will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers.
Here's a look at the Netflix share price. Not as compelling as the storytelling from the company yesterday. You can see peeling off 1.3% in after hours. The streaming giant met third quarter revenue forecasts and posted a beat in earnings and new subscriber numbers. You can see in the third quarter the 4.4 million extra subscribers that the business added. The company says it expects to add another 8.5 million in the coming months. The outlook now for Q4 as it prepares to release a deluge of content that was delayed by the pandemic before the end of the year. Now, will they return to a much more normal release schedule from next year? Our colleague Julia Borston filed this report.
Netflix reporting better than expected results, earnings of $3.19 per share. Analysts had expected $2.56. Revenue of nearly $7.5 billion came in right in line with expectations. The company's subscriber growth also beat expectations. 4.4 million new subscribers in Q3. It had forecast just 3.5 million, though in the U.S. and Canada, it added just 70,000 new subscribers. The company's fourth quarter guidance of 8.5 million new subscribers was right in line with expectations. The company is saying that it is seeing the positive effects of a stronger slate in the second half of the year, disclosing that Squid Game has been watched by 142 million member households in its first 4 weeks, which is a record. Also saying they expect the fourth quarter to be the strongest fourth quarter in terms of content offerings yet. They also anticipate a more normalized content slate next year with more originals than in 2021 and a release schedule that's more balanced, unlike this year when the content was pushed into the second half. Netflix also talking about the breadth of its competition, writing in its letter to shareholders that when Facebook saw a global outage for several hours in October, they saw a 14% increase in engagement. At the same time, Netflix also noting that the service is still relatively small, accounting for less than 10% of U.S. TV screen time. To give a better sense of that screen time going forward, the company is saying it will shift to reporting hours viewed rather than the number of accounts that chose to watch a show or movie. They will also release viewing metrics more regularly. Julia Borston, CNBC Business News, Los Angeles.
Let's take another check on the Asian markets. Don't forget, we've seen the Chinese market try to weather the slowdown we've seen in property prices. We had a flat month in September versus what we've seen in many months over the course of the last several years where there's been escalation in prices. But don't forget the big property saga unfolding around Evergrande and the debt crisis. So that has had an impact. We've got the Chinese market now flipping red at this point, matched against a little bit of green elsewhere still. Hong Kong has been one of the stronger markets today. Europe is also looking a little bit weak before we count down to the session. You can see soggy action across on the FTSE to the DAX, and in particular on the French market. That was one market that was a little bit underwater yesterday as well, in contrast to green that splashed up for the rest of the boards. But it does look like the European markets, at least on the core, will move south at the start of trade today. The US futures, we had a decent oil trade yesterday on Wall Street across the major indices, but it does also indicate a give-back day when that session begins this morning.
Let's get to Nick Nelson then. Nick is the head of European equities at UBS. Good morning, Nick. Just give us your assessment of what we're going to get in these third quarter earnings and what that means for buying European stocks.
Sure. So I think it'll be refreshing to focus on corporate profits, having spent, the last few weeks looking a lot at bond yields, Chinese property companies, macro concerns over inflation. So we're going to get back down to the nitty-gritty of corporate earnings. And look, I don't think Q3 is going to be as impressive as Q2, Q1. On our reckoning, those were the best 2 quarters for European earnings beats we've seen in over a decade. But we still expect companies to do better. We still expect beats to come through. There is, of course, input costs, as you were just referring to there in some of the chemical space. But we think in general, companies will be able to pass that on, and we'll see higher profits and higher margins and indeed more earnings beats to come.
Yeah, that's interesting, isn't it? So the read across then from those higher input prices, the problem is it's not just materials costs, is it, Nick, at this stage? We are seeing higher wage settlements and demands.
Yeah, it's fair to say we're going through a tricky patch for the cost side. As you say, materials certainly, particularly energy. I mean, energy is maybe less important as an input cost for companies now than it was 10 years ago. And obviously, as we move into a more service-based stock market and service-based economy, there's maybe a little bit less input there. But wages in certain sectors, so say hospitality, for example, obviously, you know, we hear all the stories about haulage and HGV drivers and in that supply chain. So there's clearly pockets of wage inflation, although in aggregate in the Eurozone, at least, we're not yet seeing a broad pickup in wages across the whole plate. And I think what's important to remember is we've still got a very strong demand side on the other side for companies. So in general, many companies will be able to push through a lot of these crop prices that are coming into them onto their end consumers and therefore protect their margins.
Nick, in recent years in Europe, I've seen a lot of breakout trading around results, and I wonder this time around how brutal and how euphoric investors may be on the back of earnings. I mean, we just had carry numbers today, and for me, I don't know if this stock has reset enough from the height of gains in one of its main businesses of plus 40% to just plus 4% in the Gucci business. To me, that looks like a huge setback, and I wonder in a context like this whether a market can look through stickiness around its Asian customer base. That's just one business. AkzoNobel this morning, concerns around the supply chain and raw material prices. Will investors look through some of this stuff, or do you think we're going to have a fairly brutal reaction on the back of some of the numbers we're seeing?
Well, look, I think it's fair to say, I mean, you highlight these very strong growth numbers we've had. And of course, in year-on-year terms, you know, Q2 will have been the peak, not only for the earnings, but also, of course, for economic growth in Europe in year-on-year. And will definitely fall from that, and we'll start to see some slowdown. It's worth remembering that back in August, after the Q2 results, we saw the most upgrades on record to consensus, and that data goes back 30 years. So we're coming from a very, very high peak when we look at where we are in terms of the growth rates and the comps. So there's definitely going to be some deceleration across the board, not just in China exposure and in chemicals, as we talk about there, but more broadly. But we still see about 60% earnings growth this year for European corporates. And as I say, I think there's still some more beats to come, but admittedly at a far lower level. And there will undoubtedly be some parts of the market that struggle to push on price increases, or some that may be exposed to China that we as know well has been slowing for some 6 or 9 months now.
Nick, I want to get into that psychology a little bit deeper, because you mentioned, you know, you're really looking forward to getting into the detail of the earnings season. But that said, some of what could be posted could in some ways be rearview mirror, because we are looking down the track towards an inflationary environment, and particularly in some sectors that has pricing pressure, margin issues for some corporates versus what they've been able to post now on the back of pandemic trends. Surely that must be a lingering issue, even if we do see some decent numbers on the piece of paper that's reported on the day.
Yeah, I agree. I think that the bigger picture, when we take a step back from the Q3s, undoubtedly people are looking into 2022. That's where the real debate is. I think, you know, that's where we're shifting to. Obviously, this year's nearly done now. And if you look at the consensus numbers for Europe, they're kind of high single digits, you know, 7-8% type earnings growth. And we think it'll be probably double that. So you've still got next year some pretty good top line growth in terms of economy still growing strongly and sales still growing strongly. But the consensus numbers are baking in definitely some headwinds for the margins because of the cost pressure and inflation you allude to. And I think the bigger debate we're having both at a micro level for the companies, but also at a macro level for the whole equity market, the asset allocation decision where bond yields go and so on, is of course the inflation debate and just how transitory or structural is inflation. I think we're going to see inflation carrying on our estimates into Q1, particularly in the US, and then start to fall away quite quickly. And at that point, maybe you'll see some relief. But undoubtedly, how much longer these inflation costs are going to be with us and what that does to corporate margins is, I think, the key debate for equity direction in 2022.
I've got to say, out of the numbers we've been looking at this morning, we stepped back and we looked at Nestle and thought, wow, that looks strong on what they're forecasting and the growth rate for what has been a very slow growth area of the markets in recent years. And then looking at the luxury business, the darlings of the market, and seeing the carrying numbers and thinking, well, that's actually quite bad. Do you think the market's going to have that wake-up call around certain sectors, and which ones are you watching closely?
Yeah, so I think there's definitely a chance we see a little bit of a rotation into some of the less loved value stroke cyclical parts of the market. That's partly because of this inflation story that we're seeing coming through. It's also going to be companies that can actually manage to pass that on and deliver that end pricing and protect the margins that I think are going to do well. Clearly, as we mentioned, China as a geographic region in Q3 for most, not all products obviously, but for most products may prove to be challenging given, we know the data, we've seen the PMIs, we've seen how the economy has slowed. I think exposure to domestic Europe, maybe even the US, it may look better for the third quarters. But broadly speaking, companies that can pass on, companies that have exposure to the end demand, we still think there's this strong reopening trade with consumer spending. We think there's about a trillion euros of excess savings, so above and beyond where normal savings are for Europe and US households. And that will get spent over time. So consumer-facing services, that are looked at some of this in Europe, maybe travel as that starts to open up. Those are some of the things that could do better as we go through Q3.
Nick, we're going to say goodbye. Thanks so much for helping out this morning. Nick Nelson, head of European equities at UBS. Shares in Bitcoin's first ever ETF, BITO, jumped on the first day of trade on the New York exchange. The tool will offer investors, we call an ETF a tool, I suppose it is a way of getting access, isn't it, for a lot of investors, although there's a big debate as to whether retail investors should actually ignore it and just buy the underlying, but we're not going to get into that here, I don't think. The ETF will offer investors a new way to trade the cryptocurrency. Its debut was the second largest ever for an ETF. Meanwhile, the price of Bitcoin continued to rise, approaching the all-time high of $64,899, which it hit on April the 14th.
Coming up on this show, Kering sales disappoint as the recovery slows in a key region. We'll bring you the latest from the luxury group after the break. Kering's main fashion house Gucci grew sales by just under 4% in the third quarter, missing analyst expectations as the recovery slowed in Asia. Overall sales at the French luxury group were up over 12%, driven by strong performances in the United States and Western Europe. But let's get out to Charlotte for more. Charlotte, this is stunning. I mean, Gucci has transformed the entire luxury space in recent years with the so-called Gucci effect, and now we're seeing low single-digit growth. Is that telling us Gucci has lost its way potentially, or that the pricing is too expensive?
That really will be the question, because look, Kering has been calling about the normalization of Gucci and warning about this for a long time. As you say, an incredible run since 2015, and the refreshing, the revamping of this brand has been just extremely successful. But now, so this normalization, remember that Gucci makes about half of the sales for Kering and almost two-thirds of their operating profits. So of course, what happens at Gucci is extremely important for the overall group. And as you say, these results for Q3 were very disappointing at Gucci, where their sales were at 3.8% on a comparable basis. That was way below expectations. And in Asia, in the APAC region, retail sales for Gucci were down 3% in the third quarter. So there'll be a lot of nervousness from investors of what it means for the future. Now, Kering yesterday said that they expect a very intense Q4 for Gucci, several events coming up. There's a new collection called Aria that's been very much expected, that just launched at the beginning of October. So there's very good reception for that collection, as some of the consumers actually in Asia had been holding back, just waiting for this collection to come out. There's the Gucci and Balenciaga, another Kering house. I have a collaboration coming out. It's also very awaited. There's this House of Gucci movie by Ridley Scott with an all-star cast, where the group also expect that it would be an extra exposure to the brand in the Q4. So they expect this to boost sales in Q4, and they're also putting heavy investments in marketing and innovation for this brand in Q4. They will hit actually margins in the second half because of the investment in this. So say this is not just the end of the story for Gucci. This is a centenary of the brand this year, and this year have more to offer. And remember that Kering also has invested heavily and in refreshing some of their other brands, trying to cut down a little bit of their over-reliance on Gucci, and it seems to be bearing fruit, because the other house have done very well in Q3. Yves Saint Laurent sales were up 28%, Bottega Veneta up 9%. They brought in new designers, etc., and that's been doing very well. And overall, the results were a little bit above expectations overall for Kering in Q3. So whether this is just a normalization of Gucci or whether this is a trend that will continue further down the line, that would be very interesting to see. Another interesting element to bear in mind is that Gucci also is very reliant on the Asian consumers, and there's been some concerns that's been hitting luxury stocks on the common prosperity policy that's been announced by the Chinese government there, whether this would cut down some of the sales there on luxury stock, and the slower economic growth, as we saw on the GDP numbers that came earlier from China earlier this week. So all these elements will make investors slightly nervous there on what this means for the future of Kering, because this is very different from what we heard from LVMH just a couple of days ago, that didn't see this slowdown as heavy in Asia as we saw at Kering. Karen.
Let me pick it up, Charlotte. Thanks so much for that. Let's move on and talk about the COVID situation here in the UK. The Prime Minister, Boris Johnson, says the government has not been complacent as the country reports over 40,000 COVID cases for 7 days in a row and reports the highest number of pandemic-related deaths since March. Mr. Johnson said that if current measures do not prevent, quote, unsustainable pressure on the NHS, new restrictions such as mask mandates and vaccine passports may well be introduced. Meanwhile, the UK's National Health Service is close to breaking point. The NHS, already stretched by the coronavirus pandemic, may be further strained as winter approaches. The chief executive of the NHS Confederation, Matthew Taylor, told the BBC that it may not be able to provide the level of service needed if pushed further. He encouraged mask-wearing measures and working from home. Well, I spoke with Dame Kate Bingham, managing partner at SV Health Investors and the UK's former vaccine task force chief, on the sidelines of the Global Investment Summit, where she told me the only way to prevent the creation of new variants is to get everyone jabbed.
Boosters will be important to retain protection for the elderly and the vulnerable, and there's unequivocal data that a third boost is helpful for that protection. So far, all the variants that are emerging so far are captured with all the current vaccines. So at the moment, we are seeing that the current vaccines are able to reduce death and hospitalisation and serious disease, which is incredibly happy, and we're lucky that that's still the case. Having said that, for as long as the virus is circulating unimpeded around the rest of the world, a solution for the UK will not be a durable solution. We have to get everybody vaccinated if we are to actually contain this virus.
Dame Kate Bingham also stressed the UK health space needs more than just one form of funding.
What we fundamentally need to do is to ensure that the basic science is properly funded. So here in the UK, we have a £22 billion target, and that is what I hope the government will commit to. Because without that core, vibrant academic base, we can't generate those insights for the innovative new products, which is what we all seek to invest in.
Very interesting. I think the point that Kate Bingham was making there about public investment into university R&D. And if we track the course of the development of the vaccines here in the UK, what's obvious is that the UK got a pretty good head start on the AstraZeneca-Oxford vaccine because of the work that had already been done at Oxford and the way that they were able then to use the force multiplier of government finance and support to actually develop the vaccine very quickly. So I think she makes some terrific points about the need for continued investment at the academic level. And she also, of course, made some good points in the broader conversation about how much support there is for healthcare at the moment from the investment community, given that the three funds that she's primarily focused on at SV all took in record amounts of cash over the last 12 months.
Yeah, very encouraging story, isn't it, for innovation in this country and encouraging the next generation to go into a similar field, given how monumental COVID has been for the younger generation, how it's impacted their lives. It may be an area where you see all that investment in STEM and the channeling of young girls and boys into that area of the economy, that they have a skill set now that becomes very useful down the track, and we continue to build on what we've already created around Oxford and Cambridge. But just to the broader picture, I don't know, did you have time to talk about the current health crisis, the rise in cases, the fling open the doors, rip off the mask approach by the UK government, trying to, I guess in some ways, drive up infections before winter, so it's not a problem when the much colder months start to approach?
Yeah, no, I think, I mean, her perspective on the new variants, I think, was the most interesting, where she talked about how it is just continued vaccination and take-up of boosters. And that's the issue here, that boosters are now being made available to the elderly and at risk, but the take-up is not as dramatic as you might have expected, given where we are with the current registration of infections. And it seems that people have become a little complacent about the need to get the top-ups and, of course, continue to wash hands and wear masks and do all those other protocols that will keep people safe.
Yeah, you're right. Some of those early vaccinations were administered, what, in December, and then finished up in about February for the second vaccine for the vulnerable. So we are really at that booster time for some of these people across the population. We are almost at the market open, and the signals are still weak, so we'll bring you the opening numbers shortly. European stock markets are open for trade, and the early signals have been weaker, particularly on some of these core markets, indicating another snapback. These markets are mostly firmer yesterday. The exception was the French market that was slightly weaker, and it actually seemed like the underperformer again as we've counted down to the trade today. Another big factor, earnings season. We've seen that through the United States overnight with Netflix, one of the big reporters, but a lot of European companies also reporting. We're chasing the earnings reaction today from Nestle to Asml to Kering, the owner of Gucci, and early on the markets you can see showing a tone of red. So we are moving weaker from the outset, down by about 1/4% on the stock Europe 600. Yesterday we gained about 1/3%. So giving back a lot of that territory, and you can see we're quickly matched up to that 1/3%. So we are moving into the red at the start. Let's see how broad-based some of this red ink is at the start, and what sectors it seems to be hitting at this point as we peel away from the heat map and dive into those sectors. Just 2 patches of green on the board, from food and drink to healthcare. Right at the bottom, basic resources. This has been a much stronger area of the market in recent trades. And don't forget, we've had, 4 positive sessions out of 5, and basic resources very much in the mix. So reversing strongly, down near on 2%. Rio, Antofagasta, right at the bottom of that basket. Retail stocks, it is a weak start. H&M towards the bottom. M&S also trading down, 1.6% drop for retail. Technology too. Asml at the bottom, shedding near on 3%. The sector's down 1%. This is in contrast to Wall Street, where investors parked those inflation concerns and piled back into technology for another trading session. It's just not the case here as we see the sector trade lower. Travel and leisure, a bit of a gap, you've got to say, between technology and travel and leisure, and quite a decent split in that percentage loss. Travel and leisure down just 0.6%. Real estate, similar amount, of financials, 0.5%. So we've got a reverse in a lot of these different areas of the market. Household goods, quite a split picture, I've got to say. So we've got Burberry moving towards the top of the charts. This on the back of an announcement we've had about a new CEO. That stock leading the basket, up 1.6%. And of course, we're chasing Kering stock this morning, which we'll get to in a short period of time. But the sector trades lower. Banking stocks down by about 1/10. Utilities close to the flat line. Construction trying to tilt higher at this stage. And we've got healthcare almost 2/10 in the green. Very positive start, but nothing quite like the food and drink basket. And we were just saying before, we thought those Nestle numbers were a little bit of a sit-up, take notice moment for the company and perhaps for the sector. 2.8% higher for the stock, and that, given it's such a big heavyweight, it is helping lift the overall basket and taking other stocks with it, even the likes of Danone over in France. Let's take a look at what this means for the broader indices. The FTSE, it's still holding on to 7,200 points, but it is just subtly weaker at this point. Bigger losses on the French market and on German stocks at this stage. About 1/4% stripped off both of those major indices. Similar tone for the IBEX in Spain, and the Italian market down 55 points, so about 2/10. Patch of green around that healthcare performance, and the food and drink space for the SMI. You can see very strong as it trades above 12,000 points on Zurich stocks. Well, let's go straight to that Nestle number and the performance we're seeing. The near on 3% pop in the stock. That means 11% higher so far for the year. The company has raised its full-year outlook. It's now expecting up to 7% organic growth. And don't forget, these are businesses that used to grow low single digits, so 7% organic growth. This after the food and drink conglomerate posted strong third-quarter organic sales, which beat expectations, rising 7.6%. Nestle expects its underlying trading profit margin to come in at over 17%, despite continued pressure from rising raw material costs. The company cautioned last month that inflation pressures could be higher next year. You may be wondering what exactly people are buying in the food space. I was curious this morning too, took a look. It was coffee that was a big performer. Those espresso pods still doing well, but also the Starbucks acquisition that paid off for the business. All of those products that you can get in grocery stores that are labeled Starbucks, that was really positive. And of course, the pet care. That's been a real strong performer. When you think about all the people that bought pets during the pandemic, well, some of those also then wanted the best products for those pets in terms of the food, and you can very much see it in the numbers for Nestle. And let's push on to Roche, also reporting today, and the reaction modestly firmer. It says strong demand for COVID-19 tests drove Roche shares up 8% over, sales rather, up 8% over the previous 9 months. The Swiss drug maker lifted its full-year outlook, having previously predicted a slowdown in demand for its tests in the second half of the year. Sales in its diagnostics division were up nearly 40% in the first 3 quarters of the year. The company says it now expects continued growth in the division, as well as a possible boost from an Alzheimer's drug under trial in the United States. And Kering, I've been dying to take a look at the reaction. It is weaker as anticipated, down 3.5% at this stage. The stock was up about 9% year to date, and after the reaction today, you can see it's given back some of those gains and up just under 6%. Kering's main fashion house, Gucci, grew sales by just under 4% in the third quarter, missing analyst expectations as the recovery slowed in Asia. Overall sales of the French luxury group were up over 12%, driven by strong performances in the United States and Western Europe. And let's get out to Charlotte for more. Charlotte, I think there are so many issues in these numbers for me, from Kering, from the performance of different jurisdictions. You know, what about the Asian customer, to the much slower growth rate for Gucci, which has been such an iconic story for the fashion industry.
It really has been an incredible success for carrying this Gucci story for the past few years, since 2015, and the revamping of that brand. And they've been Kering had been warning about a normalization of sales there, a soft landing. But what we saw in the Q3 numbers seems that there's something a little bit deeper there. And maybe is Gucci coming out of fashion has really been the concern for investors. And we know that Kering has been investing heavily in some of their other brands as well, to try to cut down a little bit on their over-reliance on Gucci, and it's been bearing fruit, because the numbers coming from the other houses like Yves Saint Laurent, Bottega Veneta have been way above expectation. Yves Saint Laurent sales up 28% in Q3, but the numbers of Gucci have been way below expectation, and their sales 3.8% on a comparable basis. And remember, Gucci makes half of the sales for the group, so what happens at Gucci is extremely important. 3/4 of the operating profit last year, so all the trends there are very crucial for the group. And the retail sales in APAC for Gucci were down 3% in Q3. Now the group says, look, Q3, there's been some COVID restrictions still in Asia and APAC region. That's been impacting the sales, so they hope to see a rebound in Q4. But from what we heard at LVMH, they didn't see such a big impact comparable to Kering. They said they expect a very intense Q4 for Gucci, actually, with a new collection called Aria that's been very much expected. It just launched in October, and they said it had very good reception so far. They said some of the customers actually held back spending in Q3 to waiting for this collection. There's a Gucci and Balenciaga collaboration, another Kering house that also be very much expected, and the opening of the House of Gucci movie by Ridley Scott and an all-star cast that also they expect will give some extra visibility to the brand, a bit of a boost in Q4. So they're putting also extra investments in marketing, etc., in Gucci that will actually impact some operating margin profit for in the second half of the year because of that. So they see this as a potential blip. Investors certainly are nervous that there could be something a little bit deeper with Gucci, maybe coming out a little bit of fashion. So we see this reaction this morning on the market. Even though the results overall were above expectation, the trend at Gucci is concerning investors, and we see the shares of Kering down 3.6%, right at the bottom of the CAC 40. Karen.
Thank you very much for that, Charlotte. I have been posing the question as to just how much more the luxury industry can squeeze out of consumers, and whether they've hit that pricing sensitivity too. I know people that think the product is just too expensive at this point, and across the space, are we at the high water level as investors take another look at this sector and have been piling in on the steady expansion that you've seen in profits and margins, the mix of volume and pricing? I wonder whether we are just at the end of that road for the time being. But let's talk about Burberry, because this is one stock that is bouncing, and it has been right towards the top of the household goods basket on the news that it has appointed Versace boss Jonathan Akeroyd as its new CEO, effective from next April. The UK fashion house has been searching for a new boss since June, when the outgoing head Marco Gobbetti announced plans to step down. Ackroyd joins Burberry following 5 years at Versace and 12 years at the helm of Alexander McQueen. So a slight shift in the types of brands that he's been working with towards something that is slightly more the conservative end of luxury fashion. But let's just see whether he brings any of the sizzle to the business that it's been seeking in recent years. But definitely a vote of confidence so far in the stock price move. Let's take a look at ASML. It's beat analyst expectations to report $2 billion profit for the third quarter. This is the CEO, Peter Vennick, said demand continues to be high. The stock sliding, as you can see. To Credit Suisse, which has agreed to pay US and UK regulators nearly $500 million to settle a claim relating to fraud and corruption charges in Mozambique. The Swiss lender's charges originate from $1 billion of bonds and loans it had facilitated in the country between 2013 and 2016. 3 former Credit Suisse bankers pleaded guilty to money laundering and fraud in relation to the case back in 2019. Authorities said Credit Suisse had misled investors and violated US bribery laws. The bank said it is, quite satisfied with the completion of proceedings and perhaps also to park another scandal behind it. The stock trading down 1.5%. UK inflation, very much on our radar today, and here's a broader look at stocks across the UK as we currently tick south by about 0.1%. UK inflation rose 3.1% on year in the month of September, coming in slightly lower than estimates and also below August reading. But the reading is unlikely to change the BOE watches expectations of rate rises, possibly as soon as next month. Let's get to Patrick Spencer, Vice Chair of Equities at Baird. Patrick, we've got a lot of earnings, but still we're stressing about inflation. We had a number that was not too hot out of the UK, but we had a producer prices level out of Germany that was fairly hot. So what do you make of the inflation story and how investors should be weighing it up at this point?
Yeah, morning, Karen. Well, you've had, I was looking at Bloomberg yesterday, dare I say it, but I think there was 3,000 mentions of supply chain issues. So it's very much out there. I think, everybody's very much aware of it. A lot of these problems we believe were transitory. I think the fuel problems in the UK were, BP mentioned shortages and it was self-fulfilling prophecy. Suddenly you've got, queues a mile long and panic buying and, the same, you've seen obviously in the same sort of, issues in the US. So, it's certainly a worry. I'm an old fossil. I've been around for 30 plus years in the stock market. A lot of the youngsters around haven't seen inflation, and people actually don't know how how to prepare for it. But having said that, equities are a very good place to be when you get inflation, and we can talk about the various valuations relative to bonds, etc. But certainly equities are a good place to be because generally companies pass on those increasing costs and that results in higher profits. I would have thought the conclusion is that equities are a good place to get protection from a slight increase in inflation.
Patrick, even if you have lived through an inflationary era, I think one of the issues this time around is how to label it. Is it transitory? Is it going to be entrenched inflation? Which is a slightly different view for the investment horizon. Which one is it? And if it's more short term, do you take a hedge around inflation at this point?
Yeah, that's a really good question, Karen. And you've got to remember, first of all, everybody's getting so upset about interest rates and they've got to rise for inflation. You just got to look at interest rates. They were 3% on the 10-year US 10-year in 2018. So interest rates are historically low. So they can rise a little bit. And higher interest rates aren't necessarily a bad thing. I think that's the first thing. And, where do you go now? Your second question in terms of, where do you position yourself? If you look at the S&P, the S&P's got a 20 times multiple for 2022 on a PE. And if you look at the inverse of that, i.e. the earnings yield, you're getting a 5% earning yields on the S&P. Now you've got a 1.6% 10-year yield on the 10-year US Treasury. So that means you're getting a 3.5% return on equities, over and above the 10-year US. So equities, as you know, going back to my point, that is the place to be, and that's the cheapest equities have been in terms of that ratio since 1977. So a bit of inflation isn't going to hurt. Equities are the right place to be, and interest rates will rise a little. But that's no bad thing. I mean, banks do much better in a rising interest rate environment because the yield curve steepens and they're more encouraged to lend money because they borrow short. They borrow short and lend long. So, it's attractive. So, we view the overall environment as being positive for equities and see new highs by year end. And you're entering now the seasonal strong time of year. 15 out of the last 20 years, you've seen an average gain of 7.5% in the last 3 months of the year.
Patrick, just to take you down memory lane again, there is a scenario where actually maybe that doesn't work so well, and that's if we get inflation and we get lower growth. And if you look at the Citi Economic Surprises Index, it's starting to suggest that maybe top-line growth could be challenging as we get into 2022 as consumers start to maybe not buy if they see these higher ticket prices, or indeed their income's already been taken by higher energy costs. What are the risks, do you think, around a stagflationary type economic outcome next year, and what that would do then to your equities call?
Yeah, that's another good question, Jeff. And I think you've just got to look at you talk about earnings, the revenues of companies. You've got to look at the largest market in the world, which is the US, and they are printing at the moment 15% revenue growth, and earnings were 24% at the beginning of the quarter. They're now 27% going up to 30%. I looked just this morning, out of the 57 of the 500 companies that have reported growth, you've got a 40% earnings growth. So these earnings are extremely robust. So that means obviously these companies, in fact, actually are passing on costs. The outlook for earnings next year is 10%, and margins are still reasonable. Look, everybody is awash with cash. We're all lucky enough, I'm certainly lucky enough to have worked through the pandemic, and there's this huge amount of excess cash, and that's going to be spent. You look at the retail sales in the US, look at retail sales over here, which were a little bit softer. The consumer is still in rude health. So it goes back to my original point. There's going to be some pinch points, obviously in products, and some people might walk away from that. Luxury goods, which you've just been talking about, might be one. But overall, the economy is in good shape. Companies are in good shape. They're printing good numbers, and the consumer is going to continue to spend because it's got excess savings.
Good to have you back on the channel. Patrick Spencer with us, the Vice Chair of Equities at Baird. We've got plenty coming up after the break, including SoftBank-backed warehouse robotics company AutoStore goes public, and the biggest listing on Oslo Stock Exchange in 2 decades. We're going to be speaking to the CEO, Carl-Johan Lier, right after the break. Stay tuned.
AutoStore has made its debut on the Oslo Stock Exchange. The Norwegian warehouse robotics company priced the shares at the top end of its target range at 31 Norwegian crowns. The IPO values the business at about $12 billion, making it Norway's most valuable listing in 2 decades. Japan's SoftBank bought a 40% stake in the company earlier this year for $2.8 billion. Carl Lear is the CEO of AutoStore and joins us. Carl, congratulations and thanks for coming to us on what is clearly a busy day for you. Can I just ask the obvious question for me, why list in Norway when I guess the States or maybe the London market might represent a more liquid home?
Well, we are a Norwegian company. For us, it made most sense to list in Oslo, and we think that that market also is very liquid. So for us, that was the natural place to list.
Okay, and so the reception seems to be positive this morning, I think, with the spike in the share price. Can I ask you a little bit more about what you're intending to do with the funds, who needs to be paid out, and what will be left for any further investment in the business?
Yeah, we will use part of the primary to deleverage the debt to a level that is more normal for a listed company. And then we will, of course, also have money for investing more in the business to continue to drive our growth going forward.
Carl, can I ask you a little bit about the business? Because we've seen a huge amount of e-commerce businesses during the pandemic, and clearly that would just be a step towards more robotics in warehouses and factories. What sort of trends have you seen on the back of the pandemic?
We have seen a clear acceleration of the need for more automation systems. We are a company that is very clearly linked to the growth in e-commerce. And we really saw a strong acceleration in e-commerce business after the pandemic. So that has really opened up a lot of more demand for solutions like AutoStore.
How is the market changing around the driver shortages that we've witnessed across Europe? I know that some of the businesses have been planning to get the product much closer to customers. Is that impacting you at all? Because I'm guessing we're talking about much smaller operations if they're in major cities.
Well, on the supply chain, there is a lot of challenges generally in the world economy at the moment. But we have been able to manage the need for our products or components for producing our robots, etc. So we have been able to deliver to the growth expectations for 2021, and it looks good also for 2022.
I want to ask you too about the patent issues. You and Ocado have been going at it in the courts over who breached what patent. Are you done with that now? Have you moved past some of the legal disputes?
No, we are still in dispute, and because of that, I cannot really comment on that case. But generally, we feel we have a good case and expect to prevail.
Let me ask you, if I can, then about potential new markets, Carl, for this business. You've talked a little bit about the e-commerce opportunity. How scalable is this cube storage business into other markets?
The good thing with cube storage is that it can really be used in all markets in various operations. So from the small micro-fulfillment operations to the very big distribution centers in covering really big markets. So for AutoStore, with our modularity and flexibility, we can really cover all parts of the market.
So give us a sense of where you're targeting. I mean, where the sales effort is at the moment around the world.
Well, we have sold approximately 700 installations in more than 35 countries, so we are all over the world. We have the largest market share in Europe, but expect also to continue strong growth in Europe going forward. The market is underpenetrated and will continue to grow for many years to come. But we expect more growth in North America and APAC going forward than in Europe, but also strong growth in Europe.
I'm curious about the skills shortage and the impact that's been having on the business, because we keep hearing about it from various markets, the United States to here in the UK to across in other European markets. To what extent are the customers coming to you and saying we can't hire the workers we need, and your business model and all the innovation you bring to us makes sense at this point?
Yeah, I think we see that in many countries, that it's a challenge to get warehouse workers.
to continue their manual operation, and then many companies look at automation as a good way to continue their growth. So that's clearly also one of the drivers that we see at the moment.
The other big trend we've been talking about has been inflation. Are you at all shielded from that? Do you see pricing pressures in the business when it comes to some of the inputs, and how are the customers interpreting? Can you provide that almost hedge against inflation because you're providing this technology where a lot of customers may not see as much inflation around what you're offering with, you know, as alternative to wages that may be going up down the track?
Well, there's clearly some of the supply chains. We see that there is price increases, and that's of course something that we need to take into consideration in our planning also. So we see part of it, but I would say not a major impact at the moment.
Carl, thank you very much for joining us this morning to talk us through the business model. Carl here with us, the CEO of AutoStore. With COP26 now just weeks away, CNBC speaks to energy industry leaders as part of its Sustainable Future Forum that is coming up next. Stay tuned.
Nestlé trades towards the top of the stock 600 after hiking its full-year sales guidance as the world's largest food group sees a strong return in retail sales and outside dining. Kering trades at the other end as Gucci goes out of fashion, missing forecasts on slowing third-quarter sales growth and a resurgence in COVID cases in its key Asian markets. Rising raw material costs taking the gloss off of AkzoNobel's third-quarter earnings. CEO Thierry Vanlancker tells this programme pricing pressures will only increase going into the new year.
Pricing levels are up quite significantly, as we said, for the average of the year. It will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers.
The first Bitcoin futures ETF gains on its trading debut as the spot price also jumps, pushing the cryptocurrency towards fresh all-time highs.
European stock markets have been trading for half an hour so far, and somewhat of a skittish trade around the core markets. Both the FTSE and the CAC in France flipping negative, but we are stronger on the German stock market, up by about 1/3%. So very uneven trade across the core markets versus what was a weaker trade all round for the major ones. And you can see the stock strip 600 now just bumping up by over 1/10%. We have had a lot of earnings crossing and very different reactions to across the board, from the detail around inflation, supply chain issues, demand pressures. It has been a mixed bag all round for the big corporates reporting. And let's just dive into some of the sectors and we can see what the reaction has been. I think there's also a fade in some of the hot areas of this market that have run hard in recent sessions, namely basic resources, which is right towards the bottom of the charts, sliding 1.1%. It was down a little bit more earlier, but recovering some territory. It is still the second worst performer on the boards. Retail stocks are right at the bottom now. Food and beverage strong. You can put that down to Nestle. A very strong number and outlook statement from the company today around high single-digit numbers that it's targeting now. That's a really positive catalyst for the sector, and you can see what it's done to the overall basket of stocks. Utilities round out to the top performers with a gain of just over 1%. Let's look at the stocks. Here's how it plays out at an individual level. Caring right at the bottom. That selling has escalated now as we've moved throughout the session. No surprise given the very weak low single-digit numbers that we saw from Gucci. This is a business that used to post these eye-watering numbers of plus 40-odd%, now at plus 3.8, I believe, less than 4%. Is what they've posted. So it does tell you about a slowdown effect. Kering calls it normalization, but for a company that has had so much sizzle around the remaking of a brand, it is really disappointing. Also question marks around pricing. Can it keep on improving prices if this is the reaction it's seeing in the business already? And what about that key Asian market as well? So that's a weak one. Elsewhere, you've got patches of red too in the travel and leisure sector, from TUI to IAG, the owner of International Airways. Positive trades. Delivery strong, 2.6% pop. Vestas escalating. You can see that Nestle trade. It is close to 4% higher. There's very strong performance today. Let's push on and take a look at AkzoNobel. Its third quarter core earnings missed analyst estimates. The Dutch paints maker was hurt by high raw material costs and also supply chain disruptions. The stock down 1.2%. Adjusted operating income fell 32% on year to 241 million euros. The CEO, Thierry Van Lancker, tells this show that passing on cost to consumers is more of a necessity.
Pricing levels are up quite significantly. As we said, for the average of the year, it will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers. Availability is somewhat normalizing. Where it was the big products in the beginning of the year, it's now basically a slew of smaller additives and packaging that is hampering us. We do have about 100 million euros of backlog in orders at hand for our products that we cannot supply. Now, the additives is in volume maybe a smaller part of our raw material basket, but nevertheless, if we put 1% in of a specific product in many formulas, we cannot ship those formulas. We do see it stabilizing, albeit at a sad high level. So for us, for the company, it's really showing the resilience to catch up by the end of this year, to have our pricing in sync with what the raw materials are doing.
Let's take you to Germany, and one stock on the move, Deutsche Börse, trading down 0.6% as its third quarter net profit exceeded expectations, rising 32% compared to a year earlier to 300 million euros. The German exchange group confirmed its guidance for the full year. The results were buoyed by volatility triggered by the energy crisis, which boosted trading volumes. To Vinci, which is third quarter sales have topped pre-pandemic levels as a rise in motorway traffic and major public projects gave Europe's biggest construction and concessions company a boost. Sales were up 7.8% year on year at 13.2 billion euros. That was in line with analyst expectations. And let's just dive into the Deliveroo result today and what the company's been saying, the 2.6% pop in the shares. It's raised its full-year guidance following strong third quarter results. The food delivery company grew gross value of its Q3 orders by 58% despite coronavirus restrictions. Deliveroo says it expects gross transaction value to climb 60 to 70% this year. That's a 10% upward revision from its initial 50 to 60% forecast. The stock year to date are now up 3.6%. I don't know about you, Jeff, but I feel like I'm doing a lot of takeaway ordering lately.
Quite the contrary, actually. Not so much.
But you are the chef at home, aren't you? You are the skill set.
We share those responsibilities, I have to say. But yeah, no, a lot of home cooking, actually.
I had some sushi on the weekend. There were burgers. I think there was almost some Italian food that turned up.
Not so much. No, no. More kind of roasted, home-baked, that kind of stuff. Anyway, let's move on. Quickly, let's talk about Netflix earnings. Shares in Netflix are trading lower in after-hours trade after the streaming giant met third-quarter revenue forecasts and posted a beat in earnings and new subscriber numbers. Netflix says it expects to add another 8.5 million subscribers in the coming quarter as it prepares to release a deluge of content that was delayed by the pandemic before the end of the year. It'll then return to a more normal release schedule next year.
We're going to talk about Netflix, apparently.
Oh, we? Really? I didn't think that's what it said in the auto cue, but there you go. Go on, then. What do you want to say?
I'm not sure I actually want to say anything, but, you know, we've gone down this pathway, so here we go. But I think for me it's the subscriber numbers because you've seen very lumpy old numbers, very strong initially as people were stuck at home. Yeah. And then the question mark came, well, can they sustain this? And they couldn't. We saw a drop-off in the numbers. Now we're back to some improvement as the fresh content has come into the mix. But I already hearing from Netflix they want to change the metrics around reporting viewership. They want to start reporting hours viewed rather than the number of accounts that's watched, which is telling you a little bit about shifting the pieces around to try and alter the way
always
they
worrying,
invest.
Isn't it? When any company tries to adjust the metrics on which they've traditionally measured the amount of consumption of their product, you always start to wonder if something's going slightly wrong.
Yeah, we've gone to the conversation about loyal viewers now, the binge watching versus the extra people that we're adding to the network or to the streaming service. So that's a subtle shift you're seeing. The other big one, of course, is content. And we know content is very expensive to produce and it's clearly crucial. If you don't bring anything fresh to the channel, then people are not going to sign up in droves, and that's going to have an impact on the way the investors view the stock. And I think we've very much seen that. You've got all this content lined up in Q4. It's meant to have a terrific bump up from subscribers, 4.4 to 8.5 million, so effectively doubling the subscribers that will sign up to the service. So it is telling you you've got to spend up to acquire those eyeballs still.
And that's always a problem, isn't it, for a business that's in this area, a media company, and we know this better than anybody else, being in and of the media ourselves, that it's very hard to smooth the earnings profile if you've got one key product, which is why, you know, we work for Comcast, which has obviously the television businesses, but it also has theme parks and it has the cable company and it provides internet services and some telephony. And all of that helps to offset the episodic nature of earnings from blockbuster TV shows. And NBC over the years has had its fair share of those. Obviously, we think back to Friends and what a great run that had. But and this reminds the investor of exactly what the challenge is. If you come out and you trumpet Squid Game as the great new product that you have, the savvy investor is going, terrific, love it, what next? What in 18 months' time? What are people going to be watching in 24 months' time? Convince me that you can do this on a consistent basis. And I think that, as you point out, that is the challenge for any content-focused business. They've got to find a way of showing that they can do more than just produce the occasional hit show.
There may be another threat coming to the sector as well. And don't forget our cousins over at Sky launched Sky Glass recently, and the whole point around this, and it's not the only one doing this type of work where it does pool all of the content from the various services that you have into one central area, and it can serve up content options for you. So you can watch a movie, say from Disney, from Netflix, from Sky, and there are software apps that also do this type of thing. It's trying to maximize the content that you've got already. So what if you don't have Netflix? What if you're then maximizing the content? You sort of go, well, I don't need Netflix, or I don't need another subscriber service at this point because I'm pretty happy with what I've got already. I can see all of the options, all the movies available. I didn't realize I had all of those options, and this is good enough. So perhaps the technology might actually disrupt some of these technology companies. And that's always been an issue when we talk about the tech sector. Yeah. The disruptors get disrupted.
At the risk of you know, I've mentioned Comcast, you've now talked about Sky Glass. We are not here to do a promotion for any of these products, and there are obviously competing versions out there. Just refocusing down on Netflix, the fact that you've had 22% return year to date in the share price, I think maybe also tell us a little bit more about how the price reacted after hours as investors looked at some of the free cash flow numbers and thought, if they're reinvesting a lot of this money in new content, what does that leave on the table for shareholders? And so we did get a sell-off into the after-hours trading session, but I wonder, you know, how much more gas in the tank after your 22% return. Perhaps no surprise that some investors have decided to cash out at this level.
Yeah, fascinating point is we're going to see how inflation-proof some of these businesses are in coming months. Consumers sticking around when other things are going up, this might be a good alternative. At the same time, the input costs for production, that could be escalating. This week's CNBC Sustainable Future Forum is taking place against a backdrop of spiking global energy prices in the build-up to COP26 in Glasgow next month. Well, Steve asked Ignacio Galán, the chairman and CEO of the Spanish utility Iberdrola, for his take on slow regulatory approvals for renewable projects amid rising prices for traditional energy.
Instead to have already just so bureaucratic permitting process, which is not allowing us to accelerate the construction of new renewables and more grid in most countries. If instead of that one we've been already much more agile, probably this crisis would be much less. So I think today it takes 4, 5, 7 years to obtain the permit to build an offshore wind farm and onshore wind farm or a solar PV. With the construction takes 12, 18 months. So I think this crisis, instead of being already built the size of the megawatt we are installing per annum in Europe or in the United States, we have already been able to make already more than double of those one. I think the crisis will be minimized. So what is the lesson to be learned from that one? We have to diminish the external dependence and to use already our natural resources, our renewables, for already accelerating the construction of new ones and accelerating the construction of new interconnection, new distribution grids to integrate all the renewables we have to be produced.
Today on the Sustainable Future Forum, our theme is industry response. We'll discuss sustainable aviation with Ryanair CEO Michael O'Leary. Also cover green strategies with the CEOs of Zurich Insurance, Heineken, Air and Nissan. And to round out the session, we'll be joined by our very own Tanya and EcoAge co-founder and sustainability activist Livia Fur to discuss how the fashion industry can reduce its carbon footprint.
Still to come on the programme this morning, the world's biggest cryptocurrency hovers near all-time highs after the first ever Bitcoin ETF debuted in New York. We'll talk about that when we come back. UK Prime Minister Boris Johnson says the government has not been complacent as the country reports over 40,000 COVID cases for 7 days in a row and reports the highest number of pandemic-related deaths since March. Boris Johnson said if current measures do not prevent, quote, unsustainable pressures on the NHS, new restrictions such as mask mandates and vaccine passports may well be introduced. The NHS, though, is apparently close to breaking point. The NHS, already stretched by the pandemic, may be further strained as winter approaches. This according to the Chief Executive of the NHS Confederation, Matthew Taylor. He made the comment to the BBC that the NHS may not be able to provide the level of service required if pushed further. He encouraged mask-wearing measures and working from home. I spoke with Dame Kate Bingham, Managing Partner at SV Health Investors and the UK's former Vaccine Task Force Chief, on the sidelines of the Global Investment Summit. She stressed that countries like the UK need to get more creative with how they invest in COVID-19 treatments.
At the moment, the vaccine formats are not really fit for purpose. They have cold chains, they're difficult to scale, they require, in most cases, 2 injections being delivered by a healthcare professional. So the first thing we need to have is a fundamental reformatting of vaccines, whether it's pills, patches, sprays, implants, whatever they are, which can be delivered by non-healthcare professionals, which can be scaled without that cold chain so that you can actually get to the whole world. It's no good, again, vaccinating the Western world without actually addressing all those people who are at risk. So I think vaccine format is an area of near-term investment opportunity. Manufacturing, obviously, we don't have enough or haven't had enough manufacturing supply, and there's lots of new technologies like blow-fill seal. So instead of using glass for vials for containing the vaccine itself, are there higher throughput, lower cost approaches, more eco approaches to actually vial the vaccines? Therapeutics, I mean, again, we have been quite slow to get targeted therapeutics, so I think investment opportunities into drug platforms that will allow very quick tailoring of therapeutics against new viruses is an area I would look hard at, whether that's antibodies or more likely small molecules. Antibodies are always going to be limited in terms of how many people can be dosed. And then more fundamentally, I still think immune therapies and modulating the immune response is fundamentally going to be the way medicine is moving.
Shares in Bitcoin's first ever ETF, BITO, jumped in its first day of trade at the New York Stock Exchange. The tool will offer investors a new way to trade in the cryptocurrency via brokerages. Its debut was the second largest ever for an ETF, probably aptly named BITO. It's only a bit of it's really linked to the underlying here. It's mostly linked to futures trade around the Bitcoin or cryptocurrencies. So you only really get a bit of what you had hoped to possibly trade, and that's to be invested in Bitcoin, maybe sit there and wait it out and try and track the overall price of Bitcoin. But you don't really necessarily get all of that with this ETF. But worth noting, there's a lot of popularity still. Its volume and the interest in day one exceeded that of other ETFs recently. You may recall there's one called Buzz that came to market. That was one that actually gives you a sense of trends. So it uses AI to track sentiment around public companies, for instance. So if you see lots of press articles about one particular story, this AI can give you a sense about how to trade in and around it, which we know is fairly big business for a lot of hedge funds these days. So this BITO, this ETF, actually outpaced on day one in terms of interest in the Buzz ETF.
Let me say something really obvious here. Just because this is a regulated investment vehicle doesn't mean you can't lose money. You can make money, and clearly people think that they are going to make money in Bitcoin, which is why they've been buying it and why it's been going up. But the fact that this is a collective investment tool doesn't make it any safer than buying the underlying. And in fact, there are those who argue, why pay any additional charges owning the ETF when you could ultimately buy the underlying if you want exposure, which might be a better thing to do for the retail investor. And just to make another point here, which is fairly obvious, hopefully, to most people, just because it's an ETF, that doesn't make it safe either. There are products out there like a, leveraged short oil ETF. And I wouldn't encourage retail investors necessarily to own that if they didn't really have an intimate understanding of the potential volatility around the underlying energy price. So we seem to have taken a step forward. Let's not understate that. The fact that we now have Bitcoin in a regulated product like this, I think it will encourage a lot of people to believe that we are moving steadily closer to full global regulated recognition of Bitcoin. Still, a lot of people don't really understand what it's for, other than speculating in for a better return on your money. But just be clear, it doesn't mean you can't lose your shirt.
Yeah, that was in one of the warning labels too, I think, yesterday from the chair of the SEC, Gary Gensler, is saying still highly speculative asset. I think what had taken so long, I mean, don't forget, since 2017, fund managers have been trying to bring an ETF, Bitcoin ETF to the market. And it had been rejected a number of times over because the SEC thought that the product was ripe for market manipulation. So they feel like they've got a slightly more robust product that's come to market, but that doesn't mean it doesn't go to zero at some point. And don't forget, you've got a lot of market participants who think that's still possible when you talk about a huge amount of speculation like this. But I would say the timing is interesting because don't forget, Bitcoin has been moving lately as an inflation hedge, not just because of this ETF inclusion, but because some people think, given the limited nature of what you can create in the Bitcoin space, it does in some ways protect against the inflation scenario. Although, I mean, you could spend hours debating whether that's truly the case as well. But it is about options, and for market participants having to a way to trade around some of the fears they have, number one being inflation.
Yeah, I think one of the keys, and we'll have to watch this as it develops, is will it be less volatile than the underlying, or will it mirror the volatility of the underlying? Because I think for a lot of institutional investors, they might be interested in dabbling, but they are looking for something that gives more consistent and reliable price movements. So it's a story that is going to unfold, and we'll have a lot of interest in seeing what happens next here.
Yeah, you've got to
and we'll
imagine,
continue to chart it here on the program.
Well, you've got to imagine the big news events around Bitcoin and crypto would still have market-moving implications as you talk about future pricing of the asset. I mean, some of the big ones have been Chinese regulation, the fact that the Chinese tried to stop all activity really in Bitcoin. That was a huge negative for the space. And also, we talk about American investors and an ETF. Every time Elon Musk tweets about the future of Bitcoin, surely that gets reflected too in this ETF. I don't see how that just gets stripped out because it happens to be an ETF.
No, absolutely agree with you. All the same kind of trends, and we have a story ourselves talking about how a lot of people don't actually understand in some markets it's not actually regulated to own Bitcoin. Well, let's say goodbye. Let's leave you with a look at the futures as we wrap up Squawk Box here. Street signs up in a moment. Modestly negative call to the start of the session at this hour.
Good morning, everybody, and welcome to Street Signs. I'm Juliana Tatelbaum, and these are your headlines. European markets trade mixed as investors digest the latest inflation data. UK CPI comes in weaker than expected, but still gains over 3% on the year, while German producer prices surge more than 14%. Nestle trades toward the top of the Stock 600 after hiking its full-year sales guidance, with organic growth now expected to reach 6 to 7% as the world's largest food group sees a strong return in retail sales and outside dining. Kering trades at the other end, though, as Gucci goes out of fashion, missing forecasts on slowing third-quarter sales growth, hit by a resurgence in COVID cases in its key Asian market. And rising raw material costs take the gloss off AkzoNobel's third-quarter earnings. CEO Thierry Van Lancker tells CNBC pricing pressures will only increase going into the new year.
Pricing levels are up quite significantly, as we said, for the average of the year. It will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers.
A very good morning and a warm welcome to Street Signs. A busy day on the earnings front. Let's get right to how markets are reacting. It's a mixed picture in Europe this morning. We've got a bit of red, a bit of green on the board, with a number of single stocks in focus from an earnings perspective. We did get some macro data out just a little while ago. The UK inflation print, CPI, for the month of September. And the UK enjoying a bit of relief on the inflation front, with the CPI dropping from 3.2% in August to 3.1% in September. That's the annual rate. But this is broadly in line with expectation, and analysts calling it the calm before the storm. So that's what we've got on the macro front. In terms of individual sectors, this is what the picture looks like. Split from a sector perspective as well. On the downside, we've got basic resources underperforming, down about 1.8%, alongside retail and travel and leisure. On the upside, we have oil and gas up about 1/3%. Utilities and food and bev, though, the real outperformers this morning. And turning to the individual movers, let's take a look at Nestle, because this stock is leading gains this morning, up about 3.6%. The company raised its full-year outlook, now expecting up to 7% organic growth. This after the food and drink conglomerate posted strong third-quarter organic sales, which beat expectations, rising 7.6%. Now, Nestle expects its underlying trading profit margin to come in at over 17%, despite continued pressure from rising raw material costs. The company cautioned last month that inflation pressures could be higher next year. And as you can see, it's been quite a strong run for Nestle already. So today's move higher, adding to those gains. In the luxury space, Kering's main fashion house Gucci grew sales by just under 4% in the third quarter, missing analysts' expectations as the recovery slowed in Asia. Overall sales at the French luxury group were up over 12%, though, driven by strong performances in the U.S. and Western Europe. Kering shares down 3.8% this morning. And as you can see by this share price chart, it has been a rocky road for Kering. Let's get out to Charlotte, who's been looking at these numbers in more detail. Charlotte, help us understand what investors are thinking this morning. What's driven the shares down nearly 4%?
Well, what happens at Gucci is extremely important for Kering, because Gucci makes more than about 60% of all the sales of the group and almost 3/4 of the operating profit last year. So what happens with that brand is extremely important, and it's been incredibly successful, Gucci, for the past few years. Since 2015, I had a rebrand of Gucci, and it's been very, very successful. But of course, Kering is very reliant on that brand. And so whether there was a concern from investors whether Gucci would go out of fashion at some point, and what that would mean for Kering. And Kering has been investing heavily in beefing up some of the other brands and refreshing them as well, to kind of reduce a little bit their reliance on Gucci, despite its success, to prepare for what they had called for several quarters, a sort of normalization of the sales at Gucci, a soft landing. And it's been working, because some of their brands like Yves Saint Laurent, Bottega Veneta have done extremely well. Sales at Yves Saint Laurent up 28% in Q3, but the trend at Gucci is definitely slowing. We saw the sales there were at a 3.8% 3% on a comparable basis in the third quarter. That was way below expectation. There's a question, is it just a blip or is it deeper trends at Gucci? They mentioned some of the COVID restrictions in Asia has impacted sales in particular. They said retail sales for Gucci were down 3% in Q3. But Kering saying this is just a blip. They have a few events coming in Q4 and they expect there what they call a very intense quarter for the brand. Yeah, this Aria collection that is coming out has been very much expected. And so actually some consumer customers have been holding back spending, waiting for that collection that just launched in October. It had a very good reception for that collection. You have a Gucci and Balenciaga collaboration coming out, another Kering house there. There's also been very much expected. And the House of Gucci movie by Ridley Scott with an all-star cast, they say could give extra exposure to the brand and put it at the forefront. So they expect Q4 to do better. They're putting also extra investments that could hit operating profit margins just in second half because of these heavy investments. So according to Kering, it's just a blip, but certain investors are concerned that there are deeper trends there potentially at Gucci. This impact in Asia wasn't as heavy at LVMH competitor that we reported just a couple of days ago. Didn't see the same trends as we saw at Gucci. So there's a little bit of nervousness there from investors also because Gucci is very reliant on the Asian consumers. We know there's been this common prosperity policy announced by the Chinese government and how this will impact. We know it has impacted luxury stocks quite heavily in the past few weeks and the slower economic growth in China as well as we saw from the GDP numbers earlier in the week. So all these little concerns there coming up and that's why we see these Kering shares lower on the French market right at the bottom of the CAC 40 down 3.8%. Juliana.
Charlotte, thank you so much for giving us some insight into what is driving that stock lower. Sticking with the luxury space, Burberry is gaining modestly this morning, up about 0.2%. The company has appointed Versace boss Jonathan Ackroyd as its new CEO, effective from next April. The UK fashion house has been searching for a new boss since June, when outgoing head Marco Gobbetti announced plans to step down. Now, Ackroyd joins Burberry following 5 years at Versace and 12 years at the helm of Alexander McQueen. In the chemicals space, AkzoNobel third quarter core earnings missed analyst estimates. The Dutch paints maker was hurt by high raw material costs and supply chain disruptions. Adjusted operating income fell 32% on the year to 241 million euros. CEO Thierry Van Lancker tells CNBC passing costs to consumers is a necessity.
Pricing levels are up quite significantly, as we said, for the average of the year. It will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers. Availability is somewhat normalizing, where it was the big products in the beginning of the year. It's now basically a slew of smaller additives and packaging that is hampering us. We do have about 100 million euros of backlog in orders at hand for our products that we cannot supply. Now, the additives is in volume maybe a smaller part of our raw material basket, but nevertheless, if we put 1% of a specific product in many formulas, we cannot ship those formulas. We do see it stabilizing, albeit at a sad high level. So for us, for the company, it's really showing the resilience to catch up by the end of this year, to have our pricing in sync with what the raw materials are doing.
All right, well, let's turn now to the key macro data in focus this morning. UK inflation rose 3.1% on the year in September, coming in slightly lower than estimates and below August's reading. But the reading is unlikely to change Bank of England watchers' expectations of a rate rise, possibly as soon as next month. James Henderson joins me now, Director of UK Investment Trusts at Janus Henderson. James, thanks for being with us. Let's just kick off on the back of these UK inflation numbers. So it looks like for the month of September, the UK enjoyed a bit of a relief from the recent rise in inflationary pressures, CPI dropping to 3.1% from 3.2% in August. But is this really just the calm before the storm? How do you think about these numbers?
Yes, I think that's right. There is a lot of noise around these numbers. A year ago, there was the deal on restaurants that Sunak put through, and that affected pricing, and that's working its way through. So the slight undershoot of expectations isn't very material in the scheme of it, and inflation is still looking as like it will head to over 4% in the first half of next year, before perhaps falling back this time next year a little bit. So no, I think you're absolutely right. There won't be a change in expectations that interest rates will be going up either towards the end of this year or the beginning of next year.
With that view in mind, the view that inflation could exceed 4% by the end of the year seems to be the prevailing view among economists and the Bank of England. Are you concerned that we're heading toward a period of stagflation? How does this inflation expectation tally with what you're expecting on the growth front?
I think growth is still coming through. Part of this inflation is because there is growth in the system. The supply shortages mean that people are deferring purchasing. So I think there is growth coming through. It's inflation, not necessarily stagflation, that we're looking at. Wages will be probably heading up because people will look at that 4% number and think to stand still they need it in excess of 4%. And that means that the consumer isn't badly placed. When we're moving towards fairly full employment, the consumer has got money in his pocket and the consumer will keep spending, will build his spending up. And that's not a bad background when at the same time government programs are kicking in, infrastructure programs are kicking in. So I don't see the growth being so much the problem. The problem will be inflation, and in the end, whether the inflation has to be knocked on the head by rates that go up to the extent that it throttles that growth off.
James, what do you think of UK equities against that backdrop? Are you generally bullish or bearish on UK equities?
Yes, I've been doing UK equities since 1982, and when I was much younger, we used to deal with inflation of 4 or 5% a year most years, and most years equity returns were good. I think the lessons from that period I've been thinking about a lot recently, and I think it was that a good company, really excellent companies, have pricing power. They are therefore a good hedge against inflation. And you come back to fundamentals. If a company is good enough and it's excellent in its service and product, it can ride through and put through price increases. But weaker companies get shown up, they don't get the prices through, and their margins come under pressure. So yes, the good companies, I believe, can still work well as that hedge against prices going up in the general economy.
Well, so if you will, give us a sense of where you think those opportunities, which companies, which sectors have the most pricing power in the UK that you think do present the most attractive buying opportunity here.
But any company that is answering a really pressing problem. So, for instance, on an alternative energy company, a company can come up with a product that is a fuel cell that really works or a battery that really works. Obviously, those companies, well, it won't matter what's happening in the macro economy. If those companies provide answers to the really pressing needs, they'll be fine. But more generally, companies that will benefit from higher interest rates, the financials, the banks, are showing what can happen. Their earnings are quite geared to higher interest rates. They will benefit from higher interest rates. There are parts of the market that I don't think are moving forward as you might expect as the rates go up. So insurance companies, for instance, will benefit. Their investment income line will improve as rates go up. So that's quite a wide spectre of different companies across different sectors will be helped, whilst companies that are more Me Too products that just don't have that edge, they suffer.
James, over the last several months throughout the pandemic, but particularly as we have emerged from the restricted period of restrictions here in the UK, there have been a ton of supply chain disruptions, and some here in the UK have been attributed to COVID-19, many attributed to Brexit. And I wonder if the investment community will rethink the discount, if any, that the UK market deserves because of the ongoing impact of Brexit, and whether any of these disruptions are unexpected. How are you thinking about that?
Yes, I think some of these disruptions are unexpected, and it will be worked through. And as I say, some of them will be orders deferred. So people have buying new cars, for instance, is difficult in the UK. That doesn't mean that consumer won't be buying new cars when he can. That's because of chip problems. And the length of the problem of supply of chip is surprising people. But I think we will get through this. As regards Brexit more generally, there is a lot to work through still. You know, this is the nine months into the divorce. We're still learning, and supply chains will be changing the whole time to accommodate that change. And we don't know the full effect that it's going to have in the medium term on growth rates. But at the moment, it would be a bit of a dampener. Maybe we will see trade grow with the rest of the world, but we're not particularly seeing that at the moment. The jury's out, and it'll be a fair while before you can be making absolutely strong and say exactly what it has meant for the UK economy. At the moment, as I say, it's affecting inflation. Inflation probably is higher because we have left, because of the supply chain problems being exacerbated. But you know, these could prove to be temporary.
James, we will leave it there. Thanks for joining us this morning. James Henderson, Director of UK Investment Trust at Janus Henderson. UK Prime Minister Boris Johnson says the government has not been complacent as the country reports over 40,000 COVID cases for 7 days in a row and reports the highest number of pandemic-related deaths since March. Mr. Johnson said that if current measures do not prevent, quote, unsustainable pressure on the NHS, new restrictions such as mask mandates and vaccine passports may well be introduced. Dame Kate Bingham, managing partner at SV Health Investors and the UK's former vaccine task force chief, on the sidelines of the Global Investment Summit, told CNBC that the only way to prevent the creation of new variants is to get everyone jabbed.
Boosters will be important to retain protection for the elderly and the vulnerable, and there's unequivocal data that a third boost is helpful for that protection. So far, all the variants that are emerging so far are captured with all the current vaccines. So at the moment, we are seeing that the current vaccines are able to reduce death and hospitalisation and serious disease, which is incredibly happy, and we're lucky that that's still the case. Having said that, for as long as the virus is circulating unimpeded around the rest of the world, a solution for the UK will not be a durable solution. We have to get everybody vaccinated if we are to actually contain this virus.
In the pharma space this morning, Roche is in focus. Strong demand for COVID-19 tests drove the sales up 8% over the previous 9 months. The Swiss drug maker lifted its full-year outlook, having previously predicted a slowdown in demand for its tests in the second half of the year. Sales in its diagnostics division were up nearly 40% in the first 3 quarters of the year. The company says it now expects continued growth in the division, as well as a possible boost from an Alzheimer's drug under trial in the United States. With COP26 now just weeks away, CNBC speaks to energy industry leaders as part of its Sustainable Future Forum. That's coming up next. Welcome back to Street Signs. Evergrande has reportedly paid an onshore bond coupon due this week, but the embattled property developer still faces several more interest payments as fears over its possible default continue to mount. Emily Tan filed this report.
It appears that Evergrande is prioritizing its funds towards the domestic market, where analysts say the stakes are higher for the country's financial market. The indebted developer has reportedly made an interest payment on onshore debt that was due yesterday, but that still leaves $5 bond interest payments that remain unaccounted for. The 30-day grace period for the first payment is coming up on Saturday, October the 23rd, so the market will be keeping an eye out as the deadline approaches. Evergrande has been trying to shore up liquidity, but with little success. Reports that negotiations to sell a 51% stake in its property services unit have been suspended after failing to receive support from the Guangdong government. Shares in the companies remain suspended pending an announcement of a major transaction. And this comes after Yuexiu Property backed out of a $1.7 billion deal to buy Evergrande's Hong Kong headquarters over worries about complications in completing the transaction. I'm Emily Tan in Hong Kong. Back to you.
This week's CNBC Sustainable Future Forum is taking place against a backdrop of spiking global oil, gas, and coal prices. A key takeaway from our energy sessions is the pressing need to invest in making renewable energy cheaper. Steve spoke to Siemens Energy CEO Christian Bruch and Snam CEO Marco Alvara as part of a panel on green hydrogen. Take a listen.
The capital is there and it's waiting to be invested. What's lacking are the projects that are bankable. So the capital and the investors and the companies are ready to go. What you need to make a project bankable is to have the engineering defined, but to have the revenues defined as well. Now, the revenues of a hydrogen project still depend on some form of either incentive or obligation to have hydrogen. Because the gray is cheaper than the green, if you just say, let's do hydrogen, then there is already a $100 billion per year hydrogen market out there. The exception is it's gray. So you need the fine print in the policies to incentivize or make it mandatory to switch from gray to green, to switch from gas to hydrogen, to switch from coal to hydrogen, and then it will happen very fast.
Christian, would you agree that the capital's there, that technology's up to scratch, we just need better regulation? I think all three of those points are probably debatable.
Well, as Marco said, I do agree the money is waiting there, but there's no commercial case for green hydrogen. I mean, this is one of the problems, what also Marco was alluding to by saying it's not bankable yet, which means we need to define boundary conditions which make this technology and these cases commercially viable. And we need an environment, obviously, of cheap electricity, and in this regard, abundant renewable energy available to do this. This is not there yet, and it means that certain boundary conditions in the market need to change in a long-term stable base that investors can go into these cases and say, I spent my money on it. If these cases are there, the money availability will not be the problem. And this will also then be needed to build up then the industry behind it, because also, I mean, at the end, you will need technical systems where you have the long-term reliability experiences. You know how to operate these systems for 10 or 15 years, because this is what you normally see in the power industry. This is all still to come to make it afterwards a commercial system. So the biggest problem is under the current boundary conditions, there's not yet a commercial case for green hydrogen. And this is why Marco, I believe, was alluding to the fine prints in the regulations. This is exactly what is needed now.
Steve also spoke to Ignacio Galán, the chairman and CEO of Iberdrola, after the Spanish utility firm committed another £6 billion to its UK offshore wind hub. Galán warned against shifting government regulations on sustainable financing.
Our investment is already made for next 40, 50, 60 years. So the worst could happen is to change the rules in the middle of the match. So I think the stability, predictability, and rule of law are crucial for raising the money we require for our investment. I think government is already in phase of reanalyzing, because probably the information they had were not the most correct. Now they are already analyzing more in detail, and I'm sure that we will already find out the ways to continue already the same one. Spain is very committed with the Green Deal, is very committed with Fit for 55, and is very committed to already to attract capital for making already the investment the country requires for achieving the target. So I think that was probably something was not a proper analysis, and I'm sure they now are already in the phase to reanalyze and to avoid this sort of thing happen. But I think globally, and I think that the word has been repeating this morning during the sessions here in London. So stability, predictability, rule of law for the investment, huge investment which is required for the energy transition and for the new green economy are crucial for achieving the target. So we cannot be changing the rules, because if the rules are changed, I think we can never achieve the targets which the countries are already just committed.
Today on the Sustainable Future Forum, our theme is industry response. We'll discuss sustainable aviation with Ryanair CEO Michael O'Leary. We'll also cover green strategies with the CEOs of Zurich Insurance, Heineken, EAR, and Nissan. And to round out the session, we'll be joined by Tanya Breyer and EcoAge co-founder and sustainability activist Livia Firth to discuss how the fashion industry can reduce its carbon footprint. And coming up on this show, we talk Tesla. As investors await their third quarter results, we'll look ahead at what to expect next. Welcome back to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. Nestle trades toward the top of the Stock 600 after hiking its full-year sales guidance, with organic growth now expected to reach 6 to 7%, as the world's largest food group sees a strong return in retail sales and outdoor dining. Carrying trades at the other end, though, as Gucci goes out of fashion, missing forecasts on slowing third quarter sales growth, hit by a resurgence in COVID cases in its key Asia market. Rising raw material costs take the gloss off AkzoNobel's third quarter earnings. CEO Thierry Van Lancker tells CNBC pricing pressures will only increase going into the new year.
Pricing levels are up quite significantly, as we said, for the average of the year. It will be about 20%, but frankly, in the second half of the year, it's significantly higher numbers.
And the first Bitcoin futures ETF gains on its trading debut, as the spot price also jumps, pushing the cryptocurrency toward fresh all-time highs. Well, on a busy earnings day, let's take a look at markets and how the overall European market is reacting to what we've heard from a number of companies this morning. The overall message, I think, so far, looking across earnings on both sides of the Atlantic, is that earnings are strong. And in particular, investors taking some comfort in the fact that there are no signs of widespread margin compression at the moment. So raw material pressures increasing, inflationary pressures increasing more broadly, but so far companies seem to be able to pass those rising cost pressures on to their end markets. So this is the picture for Europe. It's a mixed start to the trading session. FTSE 100, the CAC 40, and over in Spain, the IBEX 35, trading below the flat line, while we've got some green on the board for the German, Swiss, and Italian markets. A mixed picture as well from a sector perspective, with basic resources, retail underperforming, while food and bev and utilities outperform. U.S. futures, let's take a look at how Wall Street is shaping up. Very muted start there. A big day, a big week rather, for earnings for Wall Street. And the picture, much like we've seen in Europe, a strong earnings so far. Throw out one stat for you. So far, 50 of the 57 U.S. companies to report so far this season have beat earnings expectations, and yesterday was no exception. We saw 10 out of the 11 companies report beat expectations during the session, and then 4 of the after hours names beat as well. So strong corporate earnings providing a boost to sentiment, but this morning investors pausing for breath after the March higher yesterday. Now, one of the names that did report after hours yesterday is one we talked about plenty on the show. Shares in Netflix traded lower in extended trade after the streaming giant met third quarter revenue forecasts and posted a beat in earnings and new subscriber numbers. Netflix said it expects to add another 8.5 million subscribers in the coming quarter as it prepares to release a deluge of content that was delayed by the pandemic before the end of the year. It will then return to a more normal release schedule next year. Julia Borstein filed this report.
Netflix reporting better than expected results, earnings of $3.19 per share. Analysts had expected $2.56. Revenue of nearly $7.5 billion came in right in line with expectations. The company's subscriber growth also beat expectations. 4.4 million new subscribers in Q3. It had forecast just 3.5 million, though in the U.S. and Canada, it added just 70,000 new subscribers. The company's fourth quarter guidance of 8.5 million new subscribers was right in line with expectations. The company is saying that it is seeing the positive effects of a stronger slate in the second half of the year, disclosing that Squid Game has been watched by 142 million member households in its first 4 weeks, which is a record. Also saying they expect the fourth quarter to be the strongest fourth quarter in terms of content offerings yet. They also anticipate a more normalized content slate next year with more originals than in 2021 and a release schedule that's more balanced, unlike this year when the content was pushed into the second half. Netflix also talking about the breadth of its competition, writing in its letter to shareholders that when Facebook saw a global outage for several hours in October, they saw a 14% increase in engagement. At the same time, Netflix also noting that the service is still relatively small, accounting for less than 10% of U.S. TV screen time. To give a better sense of that screen time going forward, the company is saying it will shift to reporting hours viewed rather than the number of accounts that chose to watch a show or movie. They will also release viewing metrics more regularly. Julia Borstein, CNBC Business News, Los Angeles.
Chinese electric car maker XPeng is looking to bring flying cars to the market in the pretty near future. Pretty extraordinary. Arjun, it's hard to picture this becoming a reality anytime soon. What can we expect?
Well, one of the things, being here in China, I've seen, Juliana, is you see a lot of technologies being pushed forward, driverless cars here in Guangzhou. You can see them around the streets. Similarly, there are a couple of companies testing out some of these flying vehicles. And in the case of XPeng, it's got an affiliate company called HT Aero. It raised $500 million from outside investors. The company announced yesterday. Now, that's going towards R&D. And what we know about the company's plans is this. Their next model they plan to release is going to be one that can not only drive on the roads, but also fly in the air. This kind of hybrid sci-fi kind of model here as well. The company plans to roll that out in 2024. That's a very ambitious timeline, given there are a number of challenges at this point, including regulation, including safety certification, and also questions over the business model of such vehicles as well at this point. Now, just in the case of XPeng, many people might be asking, well, why is this electric vehicle maker jumping into this space? Well, quite recently, I spoke to the CEO, and he said that he sees the company more as a mobility company, however that might be, whether that be electric vehicles, whether that be flying cars as well, and also the company's developing robotics and other services like autonomous driving. So that's very much the vision for the company. As I mentioned, number of challenges here going forward in terms of, literally getting these off the ground and testing them, regulation. And so that's going to be very intriguing to watch how that pans out over the coming years, particularly here in China, where you have seen pretty quick movement on areas like autonomous driving as well, Juliana.
Well, Arjun, flying cars, these electric vertical takeoff and landing vehicles getting a ton of attention, especially from airliners or, aerospace makers across the world. And when you talk to them, one of the big challenges to getting these off the ground is regulation. So how is the Chinese regulatory landscape positioned, especially given how much regulatory focus Beijing is, making a priority right now?
Yeah, well, one of the things we have seen here is the regulators, the aviation regulators, have allowed some test flights of these sort of vertical takeoff and landing vehicles. One of the companies also based here in Guangzhou is called Yihang, and they've been testing around the city every now and then. I've had a chance to check out some of those. So they are allowing testing to happen in very controlled environments and very small environments at this point. It's not like you're seeing them flying around cities at this point. So that's very much going to be key. You see the regulators are very open to it, and you've seen that in some of these other autonomous driving technologies as well here in China. So it feels like they are pushing this. On top of that, it does fit in with some of the broader technology goals that China has laid out, namely around artificial intelligence and driverless vehicles, but also around sustainability goals. We know very much so that China is pushing, trying to push for carbon neutrality, by the year 2060. And so that's something that will feed into that, the electrification of vehicles and transport. And so you are seeing generally friendly regulation, but that's certainly not going to come at the expense of safety. That very much is the #1 priority here, and I think that's what you'll see when it comes to the regulatory environment here going forward.
Arjun, really interesting story. I just, while I have you, want to ask about Alibaba. I know this is a story you've been covering for the last, for a long time, but over the last 24 hours or so, flagging that Alibaba's shares surged about 7% in the latest trading session. What's the story there? What's driving the shares higher?
Yeah, we saw some pretty extraordinary moves. There's a couple of things at play here. Firstly, I think what's really driving it at this point is there have been 3 separate reports on the fact that Jack Ma, the founder of Alibaba, has traveled out of China and is now in Europe, particularly in Spain. Now, these reports don't agree necessarily on what he's doing there. One is suggesting he's there on a sailing trip, another suggesting he's there for business meetings and wine tasting, and a third suggesting that actually he's over in Spain for an agricultural and technology tour and learning experience as well. So different motives there, but certainly one thing we have seen is, if you remember back to October, Jack Ma made that infamous speech which appeared to criticize the regulators. We then had a series of events including the suspension of the Ant Group IPO in Hong Kong and Shanghai, and of course just since then increased scrutiny on the tech sector here. And Jack Ma has not been in the public eye as much as he used to be. That's caused a lot of speculation speculation, a lot of debate, a lot of chatter. Where is Jack Ma? And every time he's appeared, there seems to be some sort of reaction on the share price. Earlier this year in January, he came back into the public view. There was a huge surge in share price. He's been pretty low-key since, and now we hear these reports of him in Spain, and certainly that's driving some of the action, as well as a slew of new products that have been announced over the last 2 days in relation to the company's cloud business. So that's also feeding in to the reaction you've seen today in Hong Kong shares.
Arjun, thanks for covering it all, and certainly do remember that speech. It really stuck out at the time. Really different tone to what we were used to hearing out of him and many of the other Chinese corporate leaders. All right, Arjun, we'll leave it there. So nice to see you this morning. Sticking with the tech space, Tesla posts its third quarter results after the U.S. market close today, with investors keeping an eye on the firm's performance in China amid rising competition and some negative press. This is the electric car maker posted a record quarter for deliveries, increasing by almost 100% since January. But CEO Elon Musk admits the amount it being spent on vehicle parts is, quote, not great. Philippe Munoz, global automotive analyst at Jado Dynamics, joins me now. I realize in the introduction there, calling it a tech company, a fairly controversial word choice, which we can come on to a little bit later. But Philippe, just on today's earnings, what are the key metrics that you're going to be looking out for?
Well, hi, good morning. We are looking at the volume, sales volumes acceleration. I mean, Tesla is a unique case. We've seen so much growth this year. Actually, the Q3 results, the preliminary results, indicate that they confirm that there is an acceleration of this growth. The Q3 2021 volume increased by 73% compared to Q3 2020, while a year ago the growth was of 44%. Between Q3 2020 and Q3 2019. So what we're seeing here is just an acceleration of growth with only two models, Tesla Model 3 and Model Y, because the other two are having production issues, which is even more remarkable. Tesla is growing so fast, so we're also looking at its presence in the three main EV markets, which are China, US, and Europe. And spectacular results have been posted not only Q3, but also year to date.
Well, Philippe, looking longer term, you know, it's been almost 10 years since the first Model S came out, and it's only really recently that we've seen the traditional car makers really prioritize electric vehicles. But the bottom line is that they are doing that now. They are prioritizing the transition to electric. So longer term, what is Tesla's competitive advantage in a world where most cars are electric and many cars may even use or operate off of Tesla's autopilot technology? Where does that leave Tesla?
Well, Tesla, the part of the success today is that Tesla arrived first to this, let's say, party. It joined the party first. It's a pioneer. So it created this image of being the first in terms of technology, in terms of range, in terms of batteries. So today, when people, consumers around the world, not only in the US, but also in Europe and China, think of an electric car, they think of Tesla. That's its main advantage, especially in a market that is relatively new. I mean, Western car makers, European, Japanese, they are Americans, they are new in this. So Tesla is not the one who's following them, but it's imposing a trend. And this is likely to become its advantage, at least in the short term.
Well, Philippe, we've got on our board there, I'm not sure if you can see the analyst recommendations, and it's incredibly split picture. 11 strong buys, 6 buys, 13 holds, 6 sells, and 4 strong sells among the analyst community. So clearly Tesla is a hugely divisive stock. And I think when it comes to valuation, it really boils down to whether it is fair to think about Tesla as the new Apple, and where all of that brand awareness, the fan base factor in, and their first mover advantage serves them long term. Do you think that that comparison is justified, to think about Tesla as the new Apple?
Well, yes and no. As I said, it's a pioneer, but if you look at the numbers, it's not the only one growing. There are many new brands emerging in China, for example, and they are doing quite well. And in Europe, for example, we have Volkswagen Group, Stellantis, which are also growing very fast. So it's not going to be the apple of the industry, but one of the apples in the industry. Because even though it's a company that it didn't exist 20 years ago, the trend now is electrics, and we have to remember that its rivals are giants. They've been building cars for 100 years, and electrification should not be an issue for them. Of course, today, Tesla is #1 in sales and technology, but I don't think it's going to be the case in the next few years, because the traditional OEMs, they have this big know-how of how to mass produce, the mass production.
Well, it certainly seems like plenty are in your camp, but plenty would argue that it can be one apple. All right, Philippe, we'll leave the conversation there. Philippe Munoz, global automotive analyst at Jado Dynamics. Coming up on the show, the world's biggest cryptocurrency hovers near all-time highs after the first ever Bitcoin ETF debuted in New York. We discuss next.